market needs to be reduced. And so, whether we end up seeing the unemployment rate rise back to, a little over 4%, like the Fed projects, a little over 5%, like we currently project through the end of next year, I think where that tolerance lies comes down to what it's going to take to get inflation back down to target. That was the message from Jackson Hole, that they are laser focused on this and open and willing to accept some collateral damage.
And I wonder how much those workers on the sidelines, those who are not participating, how much they're focused on that high inflation number. Is there a sense that as inflation becomes more persistent, or if it is, or stays at elevated levels at least, does that bring more people back into the labor market?
I think that elevated price environment does act as a push factor for sideline workers back into the labor market, but I think there's also a pull factor with this still exceptionally strong demand. And I think one of the things we learned from the last cycle is that participation is slow to respond to conditions. So yes, we've seen the participation rate edge down since March. The household survey can be pretty volatile month to month, but I think there's still a lot of reasons to be optimistic that we do get some improvement in labor force dynamics in the coming months, given some of, again, that push factor from inflation, pushing people back into the labor market to deal with these high prices, but just as well as the pull factor of still tremendous opportunities in the jobs market right now.
That is the secret sauce for a soft landing, without a doubt, as part of it. Sarah, thank you. Sarah House of Wells Fargo, always appreciate your time. Tom, I think a lot of the economists on Wall Street this week on the same page, that we've seen some pretty resilient data. This was Neil Dutter, out of Renaissance Macro, of course, good friend of this program over the years.
Okay.
He's all right, isn't it? If slowing the jobs market is a necessary condition to achieve the Fed's inflation objectives, the Fed is far from declaring mission accomplished. He goes on to say, claims have declined for 3 weeks. The ISM manufacturing employment sub-index just rose to 54.2, the highest since March. So, Tom, there you go. A lot of people speaking, singing from the same hymn sheet going into this one. Now,
Mr. Dutta has been died optimist through all of this cycle, all of this history, including, Carl Riccadonna is coming on later with BNP Paribas. John, it's a confusing time, and what I think we need to remember, and really dovetails the market moves of this Friday with the labor interest here in 2 hours. What really matters here is how unusual the supply side is. This is an original moment that we're in, and anybody with certitude, I'm laughing them out of the room.
Sarah touched on it, Tom, with the participation rate. That's the big issue. And I think the big takeaway this week, Anna, since Chairman Powell spoke last week, is that this Fed has more work to do. Every single data point has just spoken to that theme. This Fed has more work to do.
Yeah, and we had hawkishness, of course, at Jackson Hole, as you guys witnessed, but there's more of it. We've seen every single voice since being more and more hawkish.
And to the two of you, since it is the British show, the two of you, the conversation we just had on America is completely foreign to the conversation going on in England, right?
You sound somewhat bitter about this.
There are similarities in a tight labor market.
About this.
You have a tight labor market in England. I mean, it's a tight labor market.
Yeah, absolutely. Sprinkle in a little bit of Brexit on top of all the same factors you're dealing with.
Can we get no sprinkles of Brexit on this program, Anna?
Sprinkles of Brexit.
I've been trying to avoid that for about 6 years.
That's like a Three Dog Night song from years ago.
What's that, Tom?
I'd buy that.
Sprinkles of Brexit.
Do you want to explain who that is?
Chuck, who Three Dog Night is?
Yeah, please do.
John, that's un-American.
We've done this before.
We've talked about that. Chuck Negron got together with the other two. They pieced the band together, and they said one is the loneliest number.
One is the loneliest number
you could ever live.
Okay, that sounds deep and depressing.
It is.
Okay, Future's down a 10th. I'm sure Bramo's missing this one, Tom. New it's unchanged, 325.94 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden is trying to stoke voter outrage leading up to November's congressional elections. Last night, he called on Americans to reject the politics of Donald Trump and so-called MAGA Republicans. He warned that they threaten, quote, the very foundation of our republic. House Republican leader Kevin McCarthy accused the president of slandering all Republican voters. Bloomberg's learned that the group of 7 nations are preparing to back a price cap on global purchases of Russian oil. The U.S. hopes that will ease energy market pressures and slash Moscow's overall revenues. G7 finance ministers are expected to formally back the plan today. NASA will try again Saturday to launch its Artemis 1 moon rocket. The space agency tried earlier this week, but the launch was scrubbed because of a problem with one of the rocket's engines and other technical issues. It's the first major flight in NASA's ambitious plans to return to the moon. The mission is carrying test dummies instead of astronauts. You can watch the launch Saturday on Bloomberg TV. Coverage begins 2 p.m. New York time. Shell Chief Executive Ben van Beurden reportedly is preparing to step down next year. According to Reuters, Shell has shortlisted internal candidates to become the next CEO. Van Beurden became CEO in 2014 and steered Shell through some of its most turbulent times. And Starbucks has named Reckitt Benckiser Chief Executive Lakshman Narasimhan to be its next CEO. He's a veteran of the consumer industry. He'll join Starbucks next month, whilst longtime leader Howard Schultz stays in charge. Narasimhan will fully take over next April amongst Starbucks issues, struggling sales over in China, and a push to unionize workers. Global news 24 hours a day on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
We do need to get a sense of the inflation story and how it evolves, because that ultimately tells us when the Fed is going to get comfortable slowing down. The Fed ultimately, through its action, at a minimum, is going to cause a mild recession, and the longer this goes, the harder that recession gets.
Marvin Lowe there, the senior global macro strategist at State Street Global Markets. Live from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, together with Anna out of London. We've got to catch up with Bramo next Tuesday. Long weekend for her.
Well, we are.
Long weekend for Bramo.
That's good.
Using all of Tom's vacation days, and he's very, very unhappy about it. Yields unchanged on a 10-year. Very, very close to 326, 325.75. Euro stronger after a week of choppy dollar strength. Euro dollar 99.98 and crude up 2 percentage points, Tom. 88.42 as we count you down to payrolls Friday. If you are just tuning in, it was a blowout jobs report a month ago of 528,000, the estimate.
The recession
right now,
people took a cold shower.
298. They did, Tom. I think
did.
a wise man once said
you nailed that.
the recession took a cold shower. It's in a range on this one, Tom. 452 at the high
Yeah,
end.
you did that tweet yesterday,
David
John. I
Kelly.
was surprised at the tweet that you lined up. Thank you for that. I had no
75.
idea how many people were up with Sarah House at 375.
There's a lot of people in that ballpark, yeah. In and around 300K.
Yeah. Okay, this is important. What we're going to do is do a victory lap with Anna Wong, who's really made interesting economics over the last 6 weeks. She is chief U.S. economist at Bloomberg. And what Dr. Wong has done here that's so important is there's a disinflation crew. Everybody calm down. There's a centered tendency that, John, I'm going to call Andrew Hollenhorst at Citigroup. And then there are people that saying, no, they're going to have to do a lot more. Anna Wong is in that group. You haven't budged, Anna, have you?
No, I haven't. I mean, I still believe, like anyone does, that inflation is going to come down to below 5% next year. But I just think it's going to stay and linger around 4-ish for a while.
Well, does the strategy that works here have to radically change at 4? I quoted Rudy Dornberg, Stan Fisher, Stars, and the classic textbook earlier. They would say you got to apply the same thing at 4% that you apply at 8%. Do you agree?
Yeah, I agree, because 4% is still double the Fed's target of 2%. And unless we're closer to 2%, I don't think the Fed will ease up. And I think the Fed, ease up meaning like pause hiking. And I think that Powell did say earlier that he's going to keep doing 25 basis point, even if, we're not at 5, if it's above 2%.
I was interested to read, Anna, in your notes around this jobs release today, that we have to go back to 1969 to find an unemployment rate as low as the one that we might get today. What will you be watching for in those stats?
Yeah, so I will not put as much weight on the top line monthly non-farm gains number. I think that as long as we have a falling unemployment rate and average hourly earning growth that's at the same pace as last month, then I think that will tip the balance toward a 75 basis point in September. So for top line, I think at the minimum 100K will do it if the other two things I mentioned just now happen as well.
So 100K means we go to 75. Is that what you're saying?
100K in non-farm, 100K, and also falling unemployment rate. So the unemployment rate is measured with household survey. So in the household survey, if you have only 130K increase in employment and a stagnant labor participation rate, which is what we expect, you're going to see a falling unemployment rate to 3.4%.
The labor's, I'm going to get it out here. 3, 2, 1. Sorry, Anna. The labor report today follows a labor report that was stunning 30 days ago. Why are we getting this so wrong? What is the hard part of gaming this right now?
I think, so we have as difficulty with any other people, but I think one reason is that a lot of the news coverage are on layoffs announced by these sectors, which actually comprise of a very small proportion in the total jobs market. Let's say Snap, right? This week, everybody's talking about the 20% layoff in Snap. But I look at tech services share of labor market, it's only about 1.5%. If I want to be generous and add tech manufacturing, and it's only about 2% of the jobs market. So certainly we have some industries which overhired in the pandemic who are going to have to lay off some people. I tabulated that to be those industries to be about 10% of the jobs market only. Whereas the rest of the 90%, a lot of them have underhired and still have a lot of labor shortage.
Well, let me just cut to just a basic question. How can we have a recession, I guess a normal recession, given where the labor economy is right now? It's not in the textbooks, is it?
Well, unemployment rate could jump non-linearly. Like when a recession happened, it's like there's a fire and everybody's trying to get out of the building.
This is important. Are you going to publish this? Are you going to publish a jump condition? Mike McKee's talking to me about 3.4%. Truman and Eisenhower, you're going the other way, and you're going to tell me we're going to see 100 beep or 150 beep jump condition in the unemployment rate?
Well, yeah, because just look at 1950s. I think in 1953, the unemployment rate was also around 3.4. And then a couple months later, just all it takes is a couple months, and it's 150 bips higher. So it can change very drastically.
I remember that well.
Oh, you're that old? Oh, Tom, I didn't know. Oh.
Anna, you're welcome
We're
back.
We're going down in flames.
This is great, Tom.
Anna Wong, go away.
This is perfect. Anna Wong, thank you. Tom, are you done? Or do you want to keep digging?
No, it's fine.
You sure?
I think it's great. Look, John, what we're doing when we invented this is having a lot of different opinions. Wow, are there a lot of different opinions right now?
There's a ton, and there's one person who had a massive opinion on the yield curve. About a month or so ago, it was Priya Misra of TD. And Tom, she was looking for what, negative 40 basis points on 2s, 10s, and she got it and some. We've backed away from those levels in the last couple of weeks.
Well, she got there, and what's so important is rarely, John, do you see someone give you the magnitude of the move and the timing of the move. And what was so important of what Ms. Misra did was it was the when of it. And she said, this is coming, and this is coming soon. And it's not that people are laughing at her, but we're like, yeah, okay, great. And
2s, 10s now, Tom, back to about negative 24. Surprise for me in the last week has been the backup in 10-year yields, getting back to about 325.
Yeah.
See what Priya's got to say about that.
This is really important, folks. The spread is 2 interest rates, and as John mentions, a lot of this recent movement is singularly the 10-year yield.
Priya Misra is going to catch up with us next. The global head of rate strategy at TD Securities. We'll do that in around about 5 minutes' time, live from New York City this morning. Good morning to you all with Tom Keene and Jonathan Ferro, alongside Anna Edwards this morning with Bramo out for a long weekend. She's going to be back on Tuesday. Futures negative 0.1% on the S&P. On the Nasdaq 100, we're down about 1/3 of 1%. Just a little lighter, softer, lower negative here. Going into payrolls, Tom, just around the corner.
John, yen 140.
I know.
32.
Can you get used to this, Tom?
No.
Cable at 115 and yen at 140.
I am not used to this. These
Euro,
are numbers
dollar at
of
99.99. Sounds like something on sale in a shop.
Yeah.
Unreal.
It is unreal.
From New York, this is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What we're seeing right now is severe dislocations in the labor market, right? We're seeing supply and demand imbalances.
Equities generally are reflecting a path of policy tightening.
Certainly the Fed could use any help from any front it can get at this point.
The Fed ultimately, through its action, at a minimum, is going to cause a mild recession.
This is going to be a challenging back-to-school season. It could be a challenging Christmas season.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This is Payrolls Friday, live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance, live on TV and radio alongside Tom Keene. I'm Jonathan Ferro, together this morning with Anna Edwards out of London. Bramo's going to be back with us on Tuesday. Futures down just a little bit, off by about 0.1% on the S&P 500. Payrolls 90 minutes away, TK. The estimate, 298,000.
I like where our guest is Priya Mishra is going to be with us here in moments. Must listen for Global Wall Street, and she leads with wage dynamics matter here, John. I totally agree. The ADP report, all new, spanking new, who knows? Wages, 7% plus off that report. You wonder what we're going to see about America's paycheck.
The data elsewhere, Tom, has been great all week, better than expected.
Yeah.
Even Standard Chartered and Steve England are in the team now, looking for 75 basis points in September. They had a pause penciled in November, Tom.
Interesting.
They had a pause penciled in November,
Yeah.
and they're now looking for 50 basis points there too. It's a big change, Tom, after the Chairman Powell speech of a week ago.
It's a movable feast, and you know we're going to have a lot of good guests on. Carl Riccadonna with BNP Paribas with us as well, John. But I really want to emphasize it's an unusual jobs day because it's an unusual global market. We talked a lot about yields in the last hour. Foreign exchange, John, you mentioned the word. It is unreal.
A dollar stronger. Euro dollar, 99.97. Euro bouncing back a little bit today. We've got to get used to maybe cable at 115. Dollar yen at about 140. I can tell you something that we haven't been able to say for a long, long time. Anna, the global bond market in a bear market.
Yeah, haven't been able to say that for a generation, according to the Bloomberg index. And yeah, so I mean, this is a long time. This takes us back, and we've already been back to the 70s and the 60s during this program. I guess we go back to the 80s on that front then.
Go back even further sometimes, Anna, to to the 1920s.
We mentioned
early
three,
1990s.
John, we mentioned
remembers
Three
the
Dog
20s.
Night in the last hour. I mean,
Tom's
come
lived
on.
it all. You've seen it all, TK.
We're back to the 70s. But John, seriously, Mike McKee brought this up earlier. I came in late today. I got in, about, I don't know, it was like 5:52. I think I waltzed in the door. And Mike whispered in my ear, he said, look, if we get an unemployment rate down to 3.4%, how many people out there, John, are still going to call a Truman Eisenhower unemployment rate not a fully employed America?
Well,
I just
tell
don't
you
get
this,
it.
Tom, if we get something like that, the overwhelming conclusion will be this Fed has more work to do. And I still don't think we've quite reconciled the two worlds.
Yeah,
the
fair,
world of the
fair.
Federal Reserve with the world of the White House. The Federal Reserve is tryring to get unemployment higher, Tom. It's part of the solution in their mind. They're comfortable with that idea. Not materially higher, but something closer to 4 before year end. And Tom, I wonder how that's going to settle out at the White House when we catch up with Secretary Walsh a little bit later. That's going to be a thing.
Yeah, it's going to be an interesting conversation. And John, I think to start the data, I would dovetail it off in Asia and an International Monetary Fund saying, Chairman Powell, hold on. Yen, weaker in decades and decades and decades. 139 is not 140. We tripped through to a weaker yen, 140.
We're holding on right now in the equity market from New York City this morning. Good morning. Here's the price action. Equity futures down almost 1/10% on the S&P 500. Down on the week, a little softer on the session. On the Nasdaq, we're down 30 points. We're down 1/4%. Yields unchanged, 325.37 on a 10-year. Tom talking up the dollar-yen move. Euro-dollar. Euro showing some strength for once. 99.99 going into the ECB next week. Euro-dollar seeing a move of positive 0.5%. And crude positive too, up 1.94% on WTI. 88.29. We need to talk about a G7 price cap on Russian crude a little bit later this morning. We'll catch up with Jack Fitzpatrick for that. We need to get you up to speed on what to look for in this bond market once we get that payrolls report in about 90 minutes. We can do that with Priya Misra, Global Head of Race Strategy at TD Securities, joins us right now. Priya, you've had a wonderful call on the yield curve. Let's start here with the 10-year. The 10-year started to move back out, 325, 326. What are your thoughts on that?
So I think it's been an interesting move. Some have attributed it to QT, the fact that the Fed is letting the balance sheet run off. I think we've known about QT. It's been happening for the last couple of months. I actually think this is about global interest rates. The fact that we've had a big move in bonds, in gilts, you name it. The global bond market is repricing higher. I think to the global central bank community that's willing here to risk a recession just to fight inflation. So I think it's much more global. I'm watching the ECB next week. I'm watching the Bank of England. I think that's what's going to drive the long end. But I think the Fed's telling us there's going to be pain. So I actually like owning the long end here. We're thinking that the 10-year has sort of capped out around 3.5%.
You got Toronto Dominion Bank of Toronto. And Priya, it's real simple, loony near a 132, and that's not an emerging market. You got EM and chaos. Can Jerome Powell fold in this American labor report and ignore the global economy effect?
He's got a domestic mandate. So I think he's going to look at inflation. They are looking at inflation. I think it's public enemy number one. And so those wages today or CPI in 2 weeks, I think that's still the number one priority. And, despite what's happening with the global economy, I think if inflation is high, it's much too high, and they're going to have to keep, raising rates. The terminal rate has moved up. I actually think it looks very fair here, around 4% on the terminal rate. I mean, I think the Fed's going to keep it there for a while, and we're all going to wait for them to ease, and they're going to hold steady until inflation comes down. But I think the global factors are a little secondary for the Fed right now.
So, Priya, that kind of answers my question. I was going to ask you, you're at 50 basis points for September, I think, for the Fed. What would get you to 75? I was going to ask you if it was the international context, if it was an ECB move, would that influence the Fed or make that decision easier for the Fed? But maybe it's more about the CPI print still to come then.
I think it is. I think the Fed is telling us it's the totality of data, which tells me that CPI report, which unfortunately is going to show up on blackout. It's today. It's all the data between now and then. But I will say that the market's already largely priced for 75. I mean, we're looking for 50, but I'm not fading the fact that the market's pricing in almost 3/4 of a chance of 75. I mean, if the number today is strong, we're looking for a strong number. Wages still in that 5% number. And even if inflation comes down, if service inflation remains solid, I think that 75 is a very high chance, but it's largely priced in. But it's going to come down to the U.S., I think, inflation data really for that Fed decision in September.
Priya, you talked about what's priced in and what's not. I get a ton of questions on QT. I'll talk about it later on Bloomberg Real Yield. 1 p.m. Eastern.
Oh, nice promotion.
Bloomberg
Thank
TV.
you. Please.
Priya, can you tell me what QT means for you? How does it work? What does it mean for the bond market? Yields up, yields down? I just don't get it right now.
Yeah, it's a tricky one. We don't have that much experience with QT. They just did this once in 2017-18. I mean, I think it's really the total amount of QT that matters. The way QT impacts the economy is through financial conditions. It tightens financial conditions. It actually moves real rates higher. And real rates have responded. So I would argue QT over the next 6 months to a year is priced in. What we don't know is when the Fed starts to ease, well, when they do, we do think they're going to be easing, next year. It's not so much about just the reaction function. If the economy slows down, you get a non-linear rise in the unemployment rate. They're going to have to cut rates. I would argue they stop QT then. Now, if they say, no, we're actually going to continue with QT, then I think it tightens financial conditions more. It has an impact on interest rates. So it's the non-linearity. Unlike interest rates, I think actually QT matters as it goes on. The longer it goes on, it starts to have more of an impact. It's not a very... But it's very less understood, which is why I notice that Fed officials don't really bring up QT because it's happening in the background, but it's a very powerful tool to tighten financial conditions.
Priya, there's a splash of a bear market in the bond market. I don't buy it. I think the bear market happened a lot more sooner, I should say, and particularly on a standard deviation basis. But if we get indices, full faith in credit and regular credit and high yield, if they roll over to new price down, yield up, do we get convexity where there's an acceleration, almost a fear there that people start selling off bonds? This is all new.
So I think some of that convexity we've seen through bond fund outflows. I mean, people look at their returns and they say, well, the bonds were supposed to be my diversifier, and it's been anything but a diversifier. And so they've been getting out of bonds. Where I'm worried about convexity for the credit market is if we actually have a recession. Default risk, I think, is underpriced. I think the interest rate move is largely done. But if we do have credit spreads widening, that can result in second-order effects.
She's channeling Marty Fritzen.
I know, but I had the perfect soundbite there, Tom, and you cut into it. I was going to use it later. Priya, can I come
let's
back
do it
on
again.
Let's
3,
it out.
2, 1.
My cue,
do it again.
Tell me about credit and the risks around it off the back of QT and what might happen with defaults too.
Right. So, I think there's a QT aspect, which is just moving real interest rates higher. I would argue real rates is ultimately what impacts the economy, what impacts financial conditions. And if the Fed is telling you they're willing to tolerate pain, they haven't quite defined what pain is. Is it 4% on the unemployment rate? Is it 5%? But if we're heading to 5%, and unfortunately the unemployment rate doesn't ever gradually rise, it rises much faster. At that point, I think default risk, you have to look at company credits and, the lower credit companies, I think that default risk rises, and that's negative for credit spreads. I think there'll be more decompression, which means you have to do your work to figure out what companies to own. I think this, QE help rise or both. I think that goes away. You have to do, the research here around which are the companies that have cash, that have decent earnings. But in general, I would say the lower credit sectors, I think those credit spreads can widen and total return can be much more negative.
Priya, you're one of the best. It's great to catch up. Thank you. Priya Misra of TD Securities. Always appreciate it, Priya. Thank you. High yield spreads, Tom, very close to 500 basis points again. Just starting to break out just a little bit more.
This is really important, folks. This is why we love people like Priya Misra. She comes out of her wheelhouse, which is full faith in credit, sovereign debt. And that was fascinating, John, about the default idea.
I couldn't agree more, Tom, especially when people are so comfortable with this idea that we get a downturn, it'll be short, shallow, and won't cause much damage.
John, I tear up on the summer here. Well, we'll come back and talk about this. It's so important.
What are you tearing up about?
Well, we'll talk. It's like Sprinkles of Brexit. We'll talk about it
Sprinkles of Brexit.
Anna's
Is
like
that a new song?
She's bringing back romantic memories there of June when you worked an 18-hour day, and I was over at Brown's Hotel having rum ba with Sprinkles.
I'm well aware of that.
Yeah, okay.
Nadia Lovely, UBS, is going to join us very shortly in the next hour on this equity market. Futures down about a tenth from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden has given a preview of what his campaign message will be in the run-up to November's congressional elections. Last night, he accused Donald Trump and Republicans who back him of endangering democracy.
Donald Trump and the MAGA Republicans represent an extremism that threatens the very foundations of our republic.
House Republican leader Kevin McCarthy accused the president of slandering all Republican voters. Today's U.S. jobs report could tip the scales towards a third straight jumbo-sized interest rate hike. According to a Bloomberg survey, employers added 298,000 jobs in August, and the jobless rate stayed at 3.5%. That matches the lowest in 5 decades. Those figures could be enough to lead the Fed to raise interest rates by another 75 basis points to fight inflation. And Bloomberg's learned that the group of 7 nations are preparing to back a price cap on global purchases of Russian oil. The U.S. hopes that will ease energy market pressures and slash Moscow's overall revenues. G7 finance ministers are expected to formally back the plan today. And NASA will try again Saturday to launch its Artemis 1 moon rocket. The space agency tried earlier this week, but the launch was scrubbed because of a problem with one of the rocket's engines and other technical issues. It's the first major flight in NASA's ambitious plan to return to the moon. This mission is carrying test dummies instead of astronauts. You can watch the launch Saturday on Bloomberg TV. Coverage begins 2 p.m. New York time. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Connection lost.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I'm Kaylee Lyons.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Last month's jobs report caught everyone off guard.
Surprise, oh my, as Dick Enberg would say.
That is a wow statistic.
That recession talk just got a freezing cold shower.
Today, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
It's good news, bad news, good news.
They're walking that fine line.
We still have a large gap between jobs and workers, but at least we're moving in the right direction.
The market has 2023 wrong.
The August jobs report today on Bloomberg Television and Radio.
MAGA Republicans have made their choice. They embrace anger. They thrive on chaos. While the threat to American democracy is real, I want to say as clearly as we can, we are not powerless in the face of these threats. We are not bystanders in this ongoing attack on democracy.
That was the President of the United States, an address to the nation yesterday evening. Live from New York City this morning. Good morning with Tom Keene. I'm Jonathan Ferro, joined by Anna out of London. We'll catch up with Bramo on Tuesday. We're counting you down to payrolls Friday. That number drops in about 1 hour and 11 minutes. Equity futures going into it softer, negative, down 0.1% on the S&P, on the Nasdaq 100, down around about 0.25%. No drama in the bond market for once. Your 10-year unchanged at around 326. What a move high we've seen there. 325.75 right now. Euro showing some strength, just about below parity. Euro dollar 99.91, firmer by 0.5%. Tom, you and I were talking about this after the show yesterday afternoon. The math and reading scores for America's 9-year-olds.
Oh, we were.
Deeply depressing, Tom. And I was just going through the NPR release of this, their write-up of it this morning, Tom. Reading scores, their largest decrease in 30 years. Math scores, their first decrease in the history of the testing regimen behind the study.
Anybody, John, with kids knows how serious this is. I got an email in April of last year that Afterthought was to a required math course. I called up, I said, is she dumb? And they said, no, they're just behind.
It's upsetting, Tom.
And that's a fancy school. There's a lot of people not living large where this is, they're behind by 2 years, I would say.
I've read a lot of the ways that this has been reported, Tom, and it will often say because of the pandemic, and I think we have to be far more specific than that, because of the policy response to the pandemic. And that's something we need to think about a little bit more in future years.
I agree. Certainly on the continuum, there was an initial pandemic issue, but you're right. The policy response was maybe done clumsy, but I just would cut everybody some slack. This was what it is, a major medical event, and this is one of the outcomes. The question is forward, how do we help these kids rebound?
And that's the big question, Tom, and whether we can get those schools full of teachers. You were talking about some of the vacancies there as well.
Yeah, in Boston Herald just moments ago saying there's 200 slots in Boston empty as they begin the school year. Jack Fitzpatrick can do this. We're going to rip up the script with them now with Bloomberg Government. Jack, do the teachers control the Department of Education in Washington? That is the stereotype that is out there. What is the power of teachers in your Washington?
It's a significant lobby. Looking back to the height of the worst part of the pandemic, this was a big debate, and yeah, Democrats are definitely responsive to the teachers' unions. It's hard to draw a clear line from that to the variety of policies that happened in response to the pandemic, because if you're trying to answer a question about what is federal education policy, there are probably 10,000 different answers that actually come down to local and state and that whole interplay. But the short answer is, yeah, the teachers' lobby is a significant thing, and especially for Democrats when the Biden administration came in, they're not going to ignore that.
Jack, there's percolating news this morning Which brings me back to the great unknown Secretary Yellen, who was talking about price caps and their efficacy in this war with Russia. All of a sudden this morning, maybe it's a quiet, sleepy Friday in the summer, we have some form of trial balloon football of where we are going to cap energy products to Russia. What is the focal point here for the Biden administration?
The focal point in this news on the G7 meeting coming up, it may be difficult to pinpoint a focal point for the Biden administration, for one, because they've been searching, and seemingly everybody in Washington has been searching for what are the further opportunities to put pressure on the Russian government and limit money going to the Russian government. But the key question from the Biden administration's perspective, at least, is in addition to the logistics, how many people can get on board? This is going to be a G7 agreement, but can they expand on that with other European countries? The EU has some issues. They've talked to India. That's a big challenge. It does not seem like they've made a ton of headway on getting some formal agreement to cap prices with India. But the question is, okay, what do you do to build on a G7 agreement? And that's what the Biden administration would like to. They'd like to add something to it.
Anna Edwards, is if it's a G7 meeting and it's price caps, will the United Kingdom miss Boris Johnson?
Well, we do have a prime minister, but we'll have a new one by Monday, and with that, possibly new direction. So interesting to see the way, the machine still functions, I suppose, even in the absence of the new team, the new leadership, which comes in on Monday, as Jack knows. So interesting, Jack, if they do find common ground within the G7 on this particular topic, because it seems they are apart when it comes to Iran, and that is something that's been a divide across the Atlantic of late.
The latest news on that was a negative response from the U.S. that said the last communication from Iran regarding the nuclear deal and the potential for removing sanctions was not constructive. Meanwhile, you just heard recently from Emmanuel Macron, the French president, that he thought potentially there could be a deal within the next few days on this. Overall, I don't think the U.S. has slammed on the brakes on these talks, but there had been some indications that there was a possibility of a near-term agreement before the U.S. putting out a little bit of a vague statement saying they weren't happy with what they heard from Iran. The president was supposed to take a look at this after he got back from the speech, so we may hear more specifics from the U.S. on what they like or what they don't like, but I guess a pumping of the brakes from the U.S. side on that.
How many times can we say we're close to a deal without being close to a deal? Jack, we've been saying that for about 12 months, haven't we?
Good question.
We're close to a deal.
Yeah, it's one thing to hope to be close to a deal, but the number of players in this, I think the layest news on the U.S. side indicates it's easy for someone to slow things down.
Always the way.
It's not that the U.S. has said that they're not making any progress, but it may be a little unreasonable when you hear Macron say potentially in the next few days.
Hey, Jack. Good to catch up. Jack Fitzpatrick there, down in Washington, D.C. TK, do you know who I can hear? I can hear him in the green room. Carl Riccadonna.
Oh, my word.
He's BNP Paribas. He's in the building.
He's in the building. With research.
The brand new chief U.S. economist over at BNP.
This will be good.
So we've got to catch up with him on payrolls, Tom. And also, since they're a big sponsor of the tennis, ask him why the tickets are so expensive at the Open this year.
That's the only reason we booked him.
That's it.
Try to get
going to catch up on just that in just a moment.
I want to go watch Emma play, and I guess that's not going to work out.
Future's down 2-10. She's out, Tom. She lost.
She did. I didn't notice.
You were right.
I was so
her.
far up in the stands, I couldn't tell.
A landmark climate bill passes through Congress. The expansion of nuclear energy and more investment for companies at the forefront of the fight against climate change. In this episode of Bloomberg Green, we'll explore President Biden's climate bill.
I almost think there's no superlatives that capture the breadth and scope and scale of this law.
Find out what's actually in it and where it doesn't go far enough.
The thing that's not included here is a specific hard cap on CO2 emissions or a specific legislated goal.
And look at what more needs to be done to invest in modernizing and greening U.S. infrastructure.
What we haven't had is a plan that's realistic, time-bound, pragmatic.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Switched on ESPN the other night, and Raducanu's playing first round. Who's there in a bow tie? And a beige suit, courtside. Doesn't tell me. Goes alone. TK, I'm still bitter about it. You went to the tennis and didn't tell me.
I was bitter about it too.
I had to find out on TV.
Yeah,
And you're never going to tell me either, were you?
I got nothing from Miss Raducanu. She ignored me.
Didn't even say
the entire
hi.
time. Didn't even say hi. You know.
She lost and didn't even say hello to you.
Yeah,
at
well,
the end.
she's hurt. You
You
know,
were
I'm
like
not gonna,
right there.
You know, it was sad to see. She gave it the college try.
Tickets are getting more expensive, Tom.
They're like
Check them out.
10,000. If you're not with
ridiculous.
BNP Paribas, they're
It
like
is
10,000 a seat.
ridiculous. That's why we've got BNP Paribas in the studio to find out what's
no
going
reason.
on with the US Open
That's
tickets. Stay
suspect.
tuned for that. Futures down about 0.1% on the S&P. We're down about 1/3 of 1% on the Nasdaq. Softer on the session, down on the week as well. So a little bit lighter here over the last week or so since Chairman Powell spoke, and every single day since then coming into Friday, the two-year yield has been higher. Let's check out 2s, 10s, and 30s now. Two-year yield comes in a couple of basis points to break that streak, 347.58, but we did take out 350. That's really disrupted the equity market in a major way. The 10-year backing up through 325 briefly, back to 324 going into payrolls about an hour from now, looking for about 300K, and every single data point this week claims lower than expected. ISM manufacturing decent, consumer confidence firmer, all concluding the same thing. Pretty much every single economist at this Fed has more work to do, just based on the communication we've had from the Federal Reserve. So that's the story for the bond market in America. We've got to talk about the bond market in Europe too. Priya Misra connecting the two, saying that what's happening in the US is also reflecting what's happening in Europe. Yields have been pushing higher, Tom, and that's taken a euro back to about 99.89. Euro dollar firmer by about 0.4 this morning, but through much of this week, in and around parity.
Bloomberg Dollar Index over 1,300. It's not Dow 10,000, but there's a seismic change in FX, John.
Citi, Tom, looking for 75 at the meeting next week from the ECB,
Yeah.
and maybe even 75 again from the ECB. So some big calls out there for the European Central Bank.
Well, we'll have to see. You know,
We're done.
again, we see off the jobs report here in 1 hour.
We will. You done? Any more?
I'm done.
To say,
No,
all right, cool. Okay, let's get you some stock moves. We can do that with the wonderful Kriti Gupta. Hey, Kriti.
Good morning, John. Let's talk about that chip story because we did actually get some earnings after the bell. Broadcom coming out and saying that chip story that you are starting to see, the decelerating demand, well, it's not affecting them. Their infrastructure spending is still high. So you see that chip demand story. So Broadcom shares up about 2%. A sentiment that is not being reflected in NVIDIA or Advanced Micro Devices. NVIDIA down 0.7 on the day. AMD unchanged. We'll see if that price action goes throughout the day. We have another earnings story, though. Lululemon actually coming out and saying, well, the higher income shoppers, well, they're the ones that are keeping the company afloat. Lulu shares up about 9.6%. Once again, it's that retail story that, yes, there is inflation. Yes, there are retail inventory buildup. But once again, the higher income shopper rescuing that company. Moderna, about unchanged as well, was higher earlier in the session thanks to those Omicron boosters, which are now hitting clinics across the country. So perhaps helping Moderna's bottom line. And then, Tom, the last, of course, ritual check of Bed Bath & Beyond shares. They are down about 6%. The turnaround plan still not impressing investors.
Curdy, thanks so much. Bed Bath & Beyond, I believe that's one of those meme stocks. This is a joy, and it's a joy for me personally because aerospace engineering matters. If you do aerospace engineering, you are denominator-based, looking at the change in time. That's been the hallmark of Rick Adana Economics for years as a young lad at Deutsche Bank, and massive service to Bloomberg over the years, and we are thrilled that he has the best seats at the U.S. Open with BNP Paribas. The chief U.S. economist joins us this morning. Thank you so much for the tickets last week. It was just really, really wonderful. Carl, let's cut to the chase. This is a serious moment. You lead where I am with the wage dynamic deserves study today. What will we see about wages in America?
I don't think we're going to see a significant change in trend here. We have to be cognizant that wages, like all prices, tend to be lagging indicators of real activity. And so we're going to have to see that downshift in the pace of hiring before we see any material relief on the wage front. That said, even if we look at whether it's average hourly earnings or non-supervisory and production workers' hourly earnings, we can see that a high watermark has been put in place, and there's a very modest deceleration happening. Now, you're not going to see much if the trend is 500,000 jobs per month, which has been the average year to date approximately. But if we get a slowdown into the fall, which is my belief, then you will start to see more relief.
Let's go to the x-axis, which I mentioned the DT and your engineering background. Let's go to the x-axis. This report this morning, how does it change the timeline for the Fed as they make choices? Does September become less important than November meeting, et cetera?
Well, we're in the end game here for the Fed, I believe, and the Fed is, looking for reasons to downshift from these jumbo 75 bip
Does the market
hikes.
price that in right now? That's a really important statement.
The market is trying to see that downshift coming about over the course of the fall, and it is priced into some degree. The question is whether that can happen in September or not. Ironically, if we look at the inflation numbers, they're giving the Fed some space to start moving toward that downshift. But as Chair Powell highlighted at Jackson Hole, the labor market is not giving them that space. And I suspect we're not going to get that room in today's report as well, because we're still in a hot streak for jobs.
John, why in God's name was Rick Adana not at Jackson Hole? We got to fix that.
I
next
agree.
time.
We've got to make that happen. Carl, great to see you in a new seat. Thank you, sir. And thank you for being with us. Carl, what's more important here? This idea that we get evidence of an economy that warrants a downshift in Fed hikes from 75 to 50, maybe back to 25, or the fact that the chairman is talking about the pain that we're going to see in this economy and the need to stay where we are, to hold rates and not prematurely loosen. So we could be facing, what, 3.5%, 4% Fed funds through the whole of next year. Isn't that the more important theme here?
I think that is the more important theme, John, and this was something the markets weren't getting despite speech after speech and comment after comment from Fed officials that was going to be the case. So I really think that the main mission for Chair Powell at Jackson Hole, and his speech was 4.5 pages compared to 13 pages in the prior year. He said at the onset of the speech, I'm going to be short and direct. We've got a big inflation job to tackle here, and this is going to require us parking the Fed funds rate in restrictive territory and leaving it there for an extended period, recession or not. And when he says some pain for households and businesses, I don't believe that is code language for a recession. I think he's trying something a little different in this cycle, which is not just pushing us into recession to deal with the inflation problem, but rather pushing us into an extended period of below-trend economic growth, which will generate slack and ultimately allow the Fed to fine-tune the situation. It could be recession, but even in a recession, inflation, a lagging indicator, is going to be too high, and so the Fed is going to have to keep its foot on the brake pedal. That was the core messaging from Jackson Hole. There will not be rate cuts in 2023.
Okay, and how much of a lagging indicator are jobs, Carl? How much do we need to keep that in mind as we look for the data point today?
Ordinarily, jobs are relatively a concurrent economic indicator. There's not a big lag. But what's happening, ironically, here is this huge, what I call a productivity whipsaw, right? Very early on in the recovery from the pandemic, GDP returned back to pre-pandemic levels. Only as of last month, the labor market finally notched a full recovery. That meant there was a big expansion in GDP, not as much expansion in the labor market, and so that is a big surge in productivity. Well, productivity is mean reverting, and so we've gone back into the other side of the mean over the last couple of quarters, which meant we didn't get a lot of GDP growth. In fact, it was negative in the first half of the year when we saw massive job gains. Now, that productivity trend is finally reverting back to the mean, which means that the pace of hiring will track more consistently with the pace of growth. That was not the case in the first half of the year, but gravity will reassert itself as we go deeper into the back half. I don't think in today's report, because everything's still looking very hot, so I think we could see an above consensus outcome in today's data. But as we're heading from, remember last year at this time, the GDP report in hand was saying 12% real GDP growth. As we get to the end of the year, it's going to start to look like something closer to 0 or somewhere between 0 and 1%. That kind of massive deceleration in the economy will take a very clear toll on hiring, but it's going to take a few more months for that to become apparent.
Talking of mean reversion then, Carl, I mean, you seem pretty convinced that Fed officials are not comfortable with where they are with these jumbo hikes, and they want to get to places they recognize and to do smaller hikes. What makes you so sure? Because of all of the language that you talked about at Jackson Hole, which was of such a hawkish nature, what makes you think that they feel uncomfortable where they are now?
I think I don't think they're uncomfortable with where they are now. I think they realize there's more work to be done. That was a clear message from Jackson Hole, and I think that's entirely consistent with what it's going to take to iron some of the inflation pressures out of the economy. Jackson Hole was hawkish in the construct, or in the sense that they needed to push market expectations of rate cuts in 2023 out of the picture, and the Fed largely accomplished that. I think in a short speech where he wanted to be very clear about his objectives, there wasn't room for the nuance of talking about a downshift. There was one line in the speech that made a reference to a downshift being likely and appropriate at some point in the future, but he wasn't necessarily saying this is coming up at the next meeting. We need to see some improvement on the inflation and labor indicators before that can come about. But that was a major theme in the discussions at the July FOMC, and we can see that in the minutes as they talk about policy lags, and most of the medicine that the Fed has administered has not yet been felt in the economy. So policymakers are very sensitive that there's a lot of tightening in train, and if they ignore that lagged effect of monetary policy tightening, then they will risk overdoing it. So they know there's more work to be done, but as you get closer to the landing, you do need to downshift, or you're making the classic Fed mistake of murdering the economic cycle.
So, Carl, that's Jackson Hole dealt with. Let's deal with Arthur Ashe. Do you want to tell us now why are the tickets so expensive this year?
Well, we can see a lot of service sector inflation, right? This is post-pandemic spending, the summer of services. People are pivoting from things that can be shipped to your house in an Amazon box to experiences, whether it's air travel or Broadway shows or sporting events, concerts. There's a real shift in spending, and that's keeping the economy alive and sending a false signal if you're watching those traditional retail goods metrics of activity.
John, 2 seats, men's semifinals, you and me, 23,000.
Are you kidding me? Tom, 23,000.
302.
Next weekend. Tom, for that,
no recession in those data points.
We could fly first class to Milan, and we could go and watch the Formula One at Monza.
How about Indian
instead.
Wells in March?
We could watch the Milan Derby this weekend. And fly in first class, and it would be cheaper than that. I do not understand it. I don't get it.
It's BNP Paribas' fault.
I blame BNP for this as well. It's Carl Riccadonna. You notice, Tom, that to get in that studio with you, you have to quit your job and then get a job.
That's what you have to do.
And then you can.
Really, John?
I didn't know. It's ridiculous.
Oh my word, Pharaoh Henry.
It is ridiculous. Futures unchanged on the S&P. Carl, wonderful to see you, buddy.
Sure,
just fantastic. Thank you, mate. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. President Biden is trying to stoke voter outrage leading up to November's congressional elections. Last night, he called on Americans to reject the politics of Donald Trump and so-called MAGA Republicans. He warned that they threaten, quote, the very foundation of our republic. House Republican leader Kevin McCarthy accused the president of slandering all Republican voters. The U.S. called Iran's response to the latest effort to revive the 2015 nuclear accord not constructive. That raises questions whether the two sides can reach a deal that would free up Iranian oil for global markets. U.S. officials are still looking at Iran's response, which was submitted through the European Union. And Starbucks has named Reckitt Benckiser Chief Executive Lakshman Narasimhan to be its next CEO. He's a veteran of the consumer industry. He'll join Starbucks next month, whilst longtime leader Howard Schultz stays in charge. Narasimhan will fully take over next April. Amongst Starbucks issues, struggling sales over in China and a push to unionize workers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
We think we still go meaningfully higher. So let's call that DXY at 115. It's the bear market in stocks and the bear market in bonds. And that means the dollar is effectively the only safe haven left standing.
Ibrahim Ragbari, the global head of FX analysis over at Citi, going into payrolls Friday. Payrolls about 42 minutes away. From New York City, good morning with Tom Keane. I'm Jonathan Ferro, together with Anna Edwards out of London. Bramo's going to be back with us early next week. Futures unchanged on the S&P, treading water here on the Nasdaq. We're down a little more than 0.1%. Yields unchanged on a 10-year. Let's call it 325 at 324.99. Euro dollar. Euro showing some strength. Euro dollar 99.91. We're positive 0.5%. The yen showing some weakness, TK, very briefly coming very close to a high of the session of 140.50. That high of the session now is 140.49, and just backing away just a touch in the last couple of minutes.
It's jobs day, and we're really focused on the American labor economy, but this is unusual and is of ginormous historical moment. This easily goes back to an ugly August of 1998, and frankly, John, I would take this back to the Reformation of Japan after World War II. We get wisdom here on the failed monetary experiment and fiscal experiment of Japan with Jeremy Stretch, head of G10FX at CIBC of Canada, and of course, Mr. Stretch in London. Jeremy, I don't want to make this a history lesson, but there's a point where everyone has said to me over 10, 15 years, Japan unravels. Through 140, up to an unimaginable 150, are we at the point of the unraveling of their economic experiment?
Well, it's good to be with you, Tom, and it's right that we do need to think about parallels with history, because as you correctly say, we're back to levels that we haven't seen since 1998. And in a sense, we are seeing this Japanese economic experiment really being tested, and tested quite aggressively, because, of course, we're in a world where we're talking about, and as you were previously just talking about in your last segment regarding about the policy tightening that we're expecting in the US. But of course, Japan remains in a totally different monetary orbit. We continue to see Kuroda, who of course is getting towards the end of his tenure at the BOJ, maintaining that very expansive monetary policy stance. And I think it's interesting that obviously we had Finance Minister Suzuki talking overnight regarding vigilance and suggesting, or at least implicitly hinting indirectly, that perhaps there could be measures to try and stem the slide of the yen. But it doesn't seem as though the market is taking any great notice or any great credence. And as we continue to see the market reflecting the reduction in US dollar liquidity as we move towards a more exaggerated level of US QT, the path of least resistance seems to be dollar yen higher. And I guess the question is, how tolerant are the Japanese going to be? And of course, now that we're through 140, then we're going to find that discussion of 150 is going to become ever more important.
If that's the case, Jeremy, do you think that that's the buy point for this BOJ to start leaning the other way? The big surprise from last week, and maybe I'm being a little loose with my words to call it a surprise, but if you go through all the commentary of all the central banks, the S&P, the ECB, the Bank of England, the Federal Reserve, all over the last week, all on the same page, we've got to do more. Then the BOJ saying we need to keep this easy path for monetary policy. Is there a point in foreign exchange where, Jeremy, things snap the other way?
Well, you're absolutely right that the BOJ is standing very, very much in splendid isolation in terms of its policy remit. So the question is, how much of the, or how far can the elastic stretch in terms of doing it before it does start to snap back? And in a sense, that's the classic debate about where is, or where should there be a line in the sand? Now, obviously, markets like nothing more than big round numbers. The fact that we've gone through 140 with what appears to be relative impunity takes away one obvious significant level. So we will, as I say, inevitably start to discuss and monitor and consider the risks of moving out towards 150. Now, the BOJ are still talking about the durability of inflationary pressures, and we need to see wage growth picking up in Japan. And until we see that, then it does still feel as though the BOJ, in this, as I say, end stages of the Kuroda governorship of the BOJ, are going to continue to tolerate that cheaper yen, and the market will continue to press the resolve of that BOJ policy as we move ever towards that 150 threshold.
Jeremy, you took us back to 1998, a time where we saw joint action to prop up the yen. What about policymakers coming together to rethink dollar strength? Periodically, we return to this theme. We ask questions about whether we will see some sort of coordination. Do you see levels of dollar strength that justify that yet?
No, I don't think I do necessarily. I mean, clearly, I was interested by that comment just coming out of the break regarding the bear market scenarios in bonds and equities, which leaves the dollar as the last safe haven standing. And I think there is an element of that. But I think we can and will see the dollar index probably continuing to make further gains. So that 110 threshold that we got very close to testing yesterday, I think will give way if we do see further resilience in terms of the data backdrop. And we continue to see question marks about the scope of policy tightening in other central banks. But I think it isn't the case that we're in a scenario where we're getting towards the extremes of dollar moves that would prompt the international community to start to discuss means or mechanisms to try and stem that. And I think in a sense, we're also still in an environment where there is a lack of international cohesion, which would be necessary to actually warrant those sort of discussions really taking place on any meaningful basis.
And that's the problem, Jeremy. I don't think many people have thrown around the word panic over the last week. I don't think there's been much sign of panic. I do wonder how uncomfortable the Bank of England will be, though, with seeing cable sterling drop to a 114 handle briefly just yesterday, Jeremy. What do you think they're thinking about that?
Well, I think of all of the central banks, the Bank of England are probably the one that's in the greatest bind overall because, of course, as we know from some of those more extreme inflation forecasts that we're seeing bandied around, there is a much more protracted and long-lasting inflation problem in the UK, and the peak in inflation is going to be both later and substantially higher than in most other markets. But the bank are going to find it increasingly difficult to match that sort of inflationary construct because of the weakness that we're going to see on the macro story, because clearly the UK consumer is under significant and will be under significant degrees of stress, and also the business sector, unless there will be some profound measures of support from the new incoming government to try and alleviate some of those energy price concerns. So I think the path to least resistance is probably still towards sterling weakness, which only seeks to amplify some of those inflationary pressures. And that, as I say, leaves the Bank of England in a bind, and not least of which, because, of course, the incoming administration, if we're assuming that Liz Truss will be named as Prime Minister early next week, has been quite critical of the Bank of England's reaction function. So I think from an international investor standpoint, looking at a potential divergence between the policymakers at the Bank of England and or potentially the backdrop of the government, I think that just amplifies the concerns that sterling probably only has a route lower. And if we're talking about levels from 1998 against dollar yen, then I think we may have to go back to 1985 and perhaps levels in terms towards 110 in terms of cable as a next line of focus.
Jeremy Stretcher, CIBC. Jeremy, some massive numbers to think about there. So on 110 on sterling, I guess 2 months ago might have sounded like wow, but now, after we had a little look at 114 yesterday and we're at 115.64 at the moment, maybe not such a big call anymore.
It becomes the word suddenly, and there's a lot of suddenly going on in foreign exchange right now. John, Damien Sassar was of immense value yesterday. And
he always is.
We go into this weekend with the IMF in full operational mode on EM analysis of crisis. I mean, there's no other way to phrase it.
We're in full operational mode for Payrolls Friday, Tom. The number in about 34 minutes. We're going to catch up with Jeff Rosenberg of BlackRock after the number drops. Looking forward to that from New York. This is Bloomberg.
We anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future.
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws. Because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Right now, what we're seeing is extremely solid job growth.
What we've been hit time and again is with this surprising resilience.
You're going to need to see very low growth and or negative numbers to kind of get the Fed where it wants to be.
We think we're going to see a recession early 2023 in the U.S., but it's happening earlier and deeper in Europe. It is hard to argue that the fear of recession will stop the central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance on Jobs Day. Anna Edwards in for Lisa Abramowitz. And it's real simple, John. I'm going to go against the gloom. Think optimism. Could we see an unemployment rate that takes us back to Harry Truman and Dwight David Eisenhower?
The data so far this week, Tom, has gone against the gloom. ISM manufacturing was better than expected. Jobless claims yesterday lower than expected. Consumer confidence early this week firmer than expected. And last month, let's not forget last month, Tom, 528,000. Where did that come from? The estimate today, 298.
Some chief economist said it was like a cold shower on those with the recession group. We'll have to see what we see this morning. I'm going to go with Carl Riccadonna of BNP Paribas, John, and make clear he's going to study wages. So too I, after what we saw with the new ADP report.
I'm going to go with the range, Tom. The high, 452. The low, 75. That's been the defining point of this pandemic. Through the whole pandemic, Tom, over the last 2 and a bit years, every time we've had payrolls Friday, the range, you can get a London bus through it, Tom. It's been that wide every single first Friday of the month, and it's no different today. We're still struggling to read this economy, Tom. I think that's fair to say. There's very little consensus on how big this number will be today.
With the inflation in London, the London bus is going to have a price up, up, up. Anna Edwards joins us from London this morning. They look to a new prime minister announced Monday morning. Anna, how does London, the United Kingdom, how do they perceive this buoyancy in the United States?
well, certainly buoyancy in the labour market. We'll get more details on just how buoyant and whether we're getting any pain. And it's a sort of a lack of buoyancy that the Fed wants to see, and that's going to be our focus. I suppose from the UK perspective, there are similarities and there are differences. We also have that tight labour market, but that's for other reasons, as well as similar ones to do with low participation.
I mean, John, I look at it as we set up here. We're a great set of guests here. We're going to start with equity because the stock market does matter. But John, you really wonder, is it about this report in September, or do we stagger the moment this report's out to that next Fed meeting of November?
Tom, Diane Swank of KPMG, I think, put it really well. And on Twitter earlier this week, she said it's not about September, it's so much bigger than that. The chairman's given you the playbook last Friday. It's up to you whether you believe him or not. But this is what he's telling you, that we could see some pain in this economy, and we're going to remain keeping rates in restrictive territory, Tom, for a extended period of time. And persistence is the buzzword now. Not just raise and hold, but persistence. You stay there and you do not loosen prematurely. And every single Fed official that's spoken, Tom, over the last week, and they have done repeatedly, they're on the same page.
I'm going to go on the data to the real yield. John Farrow had to blow up the real yield. You'll see it this afternoon and through the weekend. The 10-year real yield, John, is stunning. It has leaped, jump condition up to 0.80, a positive statistic. That has come far from the negative gloom of quarters ago.
Getting back towards levels that we haven't seen since maybe late 2018 when it really started to rock this credit market the last time the Fed was tightening, Tom. And maybe that's the parallel, except this time a lot of people don't think this Fed's going to back away. So how much trouble is in store in the credit market? Yields on a 10-year in treasuries unchanged at 325.56. Euro stronger, yen weaker. We talked about that a little bit earlier. Euro dollar 99.94. And crude, Tom, 88.13. Nadia Lovell and UBS, that team over there, Tom, they're looking for 125 on Brent crude.
That's
year
part
end.
Well, that's part of the
23 target as well, 125. So that's interesting.
That's right where I wanted to go, John. It's like John and I were rehearsed for this, which we never are. Nadia Lovell joins us now, senior U.S. equity strategist at UBS. And just like John was channeling Nadia, I like how you have the courage to take your equity and economic and commodity study out to mid-2023. What does the stock market look like in June of next year?
You know, we're looking for about 4,200 on the S&P 500 next year. A lot of what is going to drive where the market goes, as we all know, is where monetary policy goes. And we've heard from the Fed that we are likely to be higher and tighter for longer. So to us, that means like a more range-bound market for longer. So we're seeing modest upside from here towards 4,200. We still think those earnings estimates for 2023 needs to come down. Right now, the consensus numbers is much higher than ours. We're about 4% below the consensus numbers. And we think that the consensus is going to come towards us. And even our 2023 EPS numbers is at risk, all dependent on where ultimately that terminal rate goes.
And Nadia, how mechanically challenged is the S&P 500 given the weightings if you think the Federal Reserve is going to be higher and tighter for longer?
I think it's a challenging environment for equities. That's why we have been positioning more defensively right now. I mean, we recently upgraded consumer staples as a result of that. That is being joining our other defensive play, which is healthcare, and being offset with a barbell approach on terms of our preference for equities. And the reason why we've been positioning more defensively because we do expect that the economy to slow. I think we can all agree with that. The magnitude of the slow is what is going to be debated. But consumer staples tends to be more resilient in an economic slowdown. There's a strong inverse relationship between its relative performance and the changes in the ISM manufacturing index, which yesterday was strong, but we do expect it to decline and even contract as we head into 2023. We've also seen a pullback, of course, in agricultural and commodity prices. And so that should help alleviate some of the pressures that consumer staples have been seeing. So we expect a more resilient earnings environments for consumer staples versus other areas of the market. And so we're positioned even more defensively heading into 2023.
JP Morgan has been super constructive in a way that UBS hasn't. And through much of this year, so far they've been wrong, but we've still got some time left for this year to see if they'll be right. One spot that they do like, and they have been right on that, is the energy sector. Marko Klanovic and the team put out this note yesterday evening. The energy sector remains in a particularly sweet spot. Nadia, I guess my question to you, after what you just said about staples, do you agree with that? And what's the correlation between, say, the energy sector and the ISM, if we're expecting the ISM to roll over in the coming months?
Yeah, we do agree that, you know, energy still remains favorable. I mean, we've been saying that for 2 years now, and each time we've seen energy pull back, we've been recommending buying that dip, and that's worked. And we think that strategy will continue to work. I mean, even though you might expect the economy to slow, we still think that the supply-demand dynamic still favors prices across the energy complex to be higher and stay elevated, especially as we enter the winter months. I mean, we know that Europe is going to have likely an energy crisis. I mean, we have the OPEC meeting on Monday, but we're not expecting much outcome of any changes from OPEC at all. Some of it depends on the potential for Iran nuclear deal. But even in that, as you noted earlier, we still expect that, you know, Brent oil prices to get to $125 because of these supply and demand imbalances. And, you know, that should be supportive to the energy equities. And when you look at second quarter earnings, energy was strong.
And you might not be worried about, good to speak to you, Nadia, you might not be worried about balance sheets at oil and gas companies if we do see oil back up at $125. But are you worried about balance sheets more generally? From an equities perspective, John was talking about how there's increasing concern about credit and whether credit markets are really pricing in recession risk accurately. I wonder, are you looking at dividend cover? Are you looking at strength of balance sheets? Are you looking at the profile of debt repayments? Is that looming large for you?
It's something that we continue to monitor, but what I can say is that balance sheet across most companies remain fairly strong. I mean, we've had this low interest rate environments, and that's given companies the opportunity to really push out some of those maturities. We also look at corporate balance sheet. Companies have quite a bit of cash on their balance sheet, whether that be tech companies or healthcare companies, and also obviously, you know, energy companies now being flush with cash. So we're less concerned about, you know, companies broadly in terms of their balance sheets, because we just think that they're better positioned going in to even this economic downturn and a potential recession, which isn't our base case. We don't think that we'll get a recession.
Nadia, can we play good news, bad news at 8:30 Eastern? Just to wrap things up. I guess you knew this was coming.
Nadia.
You knew this was coming. If good news this week was bad news, what's bad news at 8:30 if we get some bad news? Is it good news or bad news? What is it, Nadia? What game are you playing?
Well, you know, if we get another print like we got for the July number, I think that is going to be bad news from a Fed standpoint.
Nadia, the research piece this week that had the most profound impact on me was Luke Kawa boiling water with lobsters and potatoes. I don't know if you saw that on Twitter.
Was awesome.
Nadia, what is it like to breathe the same air as Luke Kawa at UBS?
You know, it's good.
They love each other, Tom. They may well be on different teams, though, TK. It's a big bank.
Well, yeah, but you know,
it is a large bank.
You know, they.
Nadia Lovell of UBS.
Nadia, thank you
Nadia,
so much.
You.
Love the
We appreciate
2023 look.
I think that was great news is bad news, Tom. I think that was the takeaway. Great news is bad news.
You're killing me. My head just starts. You're doing it just for me.
That was just for you.
I mean, you wouldn't do this to Anna Edwards.
I'm not doing it to Anna. It's just for you. It's just to wind you up. It's just to wind you up.
There's so much navel gazing going on right now.
It's
John, let's get humble.
Friday. Come on.
John, 30 days ago, in 20 minutes, was stunning.
No one was saying 500K
was
plus.
Stunning.
I agree.
Was just stunning.
I agree.
What if we get that kind of number again?
Patrick Harker of the Philadelphia Fed told me, sat alongside us in Jackson Hole this time last week, and I think he spoke to that humility. This cycle's moving really quickly, Tom.
I agree with that. I think that's very important.
2 years into this, coming out of that mess back in 2020, still trying to keep up. Still trying to keep up and struggling to keep up.
Goes back to the x-axis. I'm watching yen. We're going to dash to 141 here. Absolutely stunning.
Euro dollar 99.99. Just like saying that. That currency pair now at parity, positive 0.5%. Randy Crozen's going to join us shortly, economics professor at the University of Chicago, and of course former Fed governor. We'll see if he's got any US Open tickets, TK. Ask him in the break, see what he says. We'll ask him on air too. Payrolls Friday just around the corner. Then we'll catch up with Mr. Rosenberg, Jeff Rosenberg of BlackRock, off the back of that. Futures totally unchanged as you might expect them to be. Going into payrolls, that number is just 18 or 19 minutes away. Heard on radio, seen on TV. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. Less than 20 minutes away from that crucial US jobs report, the numbers for August are expected to show that payrolls expanded by 298,000 and the jobless rate stayed at 3.5%. That would match the lowest in 5 decades. Those figures could be enough to lead the Fed to raise interest rates by another 75 basis points to fight inflation. President Biden is trying to stoke voter outrage leading up to November's congressional elections. Last night, he called on Americans to reject the politics of Donald Trump and so-called MAGA Republicans. He warned that they threaten, quote, the very foundation of our republic. House Republican leader Kevin McCarthy accused the president of slandering all Republican voters. And Bloomberg's learned that the group of 7 nations are preparing to back a price cap on global purchases of Russian oil. The U.S. hopes that will ease energy market pressures and slash Moscow's overall revenues. G7 finance ministers are expected to formally back the plan today. NASA will try again Saturday to launch the Artemis 1 moon rocket. The space agency tried earlier this week, but the launch was scrubbed because of a problem with one of the rocket's engines and other technical issues. It's the first major flight in NASA's ambitious plan to return to the moon. This mission is carrying test dummies instead of astronauts. You can watch the launch Saturday on Bloomberg TV. Coverage begins 2 p.m. New York time. And Bloomberg's learned that Japan's SoftBank is planning to cut at least 20% of the staff at its Vision Fund operation. The world's biggest tech investor will slash a minimum of 100 positions. Earlier this summer, the Vision Fund posted a record $23 billion loss. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It's the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
I'm Kaylee Lines.
And I'm Damian Sassower. Join us each week on our brand new show, The Lineup. If you're betting on the Mets, it's a pretty good return.
We'll cover the latest trends in sports betting, the hottest matchups, shifting spreads, and the data you can't find anywhere else. It is crazy how much the money line has changed from the preseason to now.
Plus, expert insights from special guests.
The Eagles got a gem on their hands. I hate to say it because they're in the NFC East with the Giants.
Odds are it'll be your favorite way to stay in the game.
Catch The Lineup Fridays and Saturdays only on Bloomberg.
Monday, the UK Conservative Party decides who will succeed Boris Johnson as Prime Minister. As Rishi Sunak and Liz Truss go head-to-head, keep it tuned to Bloomberg for the latest news and up-to-the-minute results. Bloomberg, your global business authority.
The danger is wages really get behind, and so there needs to be a catch-up, and then there will be a catch-up of prices. So this is a very important time now that the Fed and other central banks as well can address the inflation, so there's less of a need. Workers see less of a need to adjust wages.
That was John Taylor, the professor of economics at Stanford University. I always get excited when I see out the corner of my eye Mike McKee making the walk into the studio on a Payrolls Friday. That number dropping in about 12 minutes time. I'll get my maths right, Tom. 12 minutes time, not 20, 12 minutes away. Mike McKee's going to break that down for you. Jeff Rosenberg of BlackRock's going to break it down too. The number you're looking for, 298,000. The range is just wide. 452 is the high, 75 is the low. You all remember the previous number of about 520.
I nailed that.
Okay, I don't think anyone nailed that. Going into it, Tom, futures unchanged on the S&P, little lighter, softer, lower, negative 0.2 on the NASDAQ 100, and yields unchanged to it. Let's call it 326 on a 10-year.
Let's get right to it right now, and we do that after listening to John Taylor of Stanford University, and of course, all of his great work on really thinking through our monetary process. Randy Krasner is the former governor of the Federal Reserve System, economic professor at the University of Chicago, and someone who's read John Taylor cover to cover. Randy, I understand that you did not dress as a raisin to show microeconomics in freshman economics, as Professor Taylor has done at Stanford. But I do want you to talk here about the efficacy of a rules-based central bank that John Taylor codified with the Taylor Rule. How distant is this modern Federal Reserve from being rules-based?
Well, I think the Fed has articulated a different set of rules, a different approach in their average inflation targeting. And unfortunately, I think that may have gotten them into a bit of trouble and getting a bit behind the curve, saying since we had low inflation for a while, we can wait before trying to respond to inflation rising. So I think they had a form of a rule, but one that just didn't work out so well.
Are jobs of Americans part of that new rule?
I'm sorry, our jobs?
Our jobs in America, jobs, the labor economy, is it part of their set new rule?
It certainly is.
That's all I get? I mean, just, John, help me here. Governor Krasner's
giving me,
he's giving me short questions here. No,
trying to give you a short answer.
No, but Randy, I think this is really important. Where does the new labor economy, we're all observing a boom economy in labor, a fully employed America, an unemployment rate that goes back to Truman and Eisenhower, and we're trying to figure out what the rules of the road are for this central bank. What are they with labor?
And so they are certainly, they understand that the labor market is very tight. And we have this really unusual circumstance of having so many vacancies relative to the number of unemployed people. And of course, that means a super tight labor market, lots of wage pressure, just as John Taylor was talking about. And the key thing that the Fed is focusing on is making sure that those wage expectations that have been very high recently don't continue to stay so high, because that's going to make it very difficult to pull inflation down if people continue to demand very high wage increases.
Randy, really good to see you. It's Anna in London. Where do you think the assumed transmission mechanism of these higher rates, where could it all fall down? You described there some of the process, so interest rates go higher and they want to weigh down on job vacancies, weigh down on wage demands, weigh down on inflation. Where could that go wrong and not actually happen?
Well, it could be that there's this fundamental disequilibrium in the labor market. Some Fed people have talked about that. That makes it very difficult because we've got so many disruptions. We've got such a big mismatch between what the firms are looking for and the skills that people have, that you might not get the normal circumstance of higher interest rates sort of leading to higher unemployment. I think we'll get there. I think, monetary policy has impacts with long and variable lags, as Milton Friedman has famously said. They really only started on this path about 6 months ago, and it's usually 6 to 18 months that most economists would think that Fed policy has its major impact. So by this fall, we should be seeing it. Obviously the market continues to be on fire here as well as in most countries.
Right. So, Randy, by that logic, the jobs print we get today is really only responding to what talk of a Fed hike, or the very first Fed hike.
Yeah, in some sense, it's the echoes from the past that will be coming in. I think that's exactly right, because it's long and variable lags. It doesn't just, the Fed raises rates. It doesn't mean that the economy just goes down or that the unemployment rate goes up. It takes a while.
Randy, you're going to be sticking with us, I'm happy to say. Randy Kreisner there of the University of Chicago, going into payrolls about 7 minutes away. Mike McKee in the seat, microphone switched on. Mike McKee, what are you looking for in about 7 minutes' time?
A lot of the ancillary indicators have suggested that we might get an upside surprise for the month. But one thing to consider is that the Bureau of Labor Statistics has gone back to an older form of their seasonal adjustment. They changed it during the pandemic because the numbers were so wildly out of whack. So there could be a very large seasonal component to this that would subtract a lot of numbers. We'll look for that.
Interesting. Are you looking for a revision to that previous month as well, Mike, that 520?
Yeah, there's pretty much always revisions, and interestingly enough, July is usually revised higher. So we could see a bigger number. And one thing to watch for going forward is the government's already announced that there is something like 526,000 jobs over the past year that have not been allocated to various months yet, but that overall employment is about 500,000 higher than they originally reported. We'll get those assignments come January, but they've got the preliminary number out. So we still see a strong labor market.
TK, get out the blindfold and get out the dartboard, I guess. It's one of those. Feels that way.
It's after
looking at the range of estimates.
Yeah, and I think that should be considered normal, John. We forget we're at a pandemic. I saw one data point yesterday of deaths going back above 500. Again, not to be inflammatory on that, but this is so unusual and so original versus other cycles. The compare and contrast back in history, I think, is really risky.
Yeah, we're all with you, Tom. To have a range that wide at 452 versus 75.
We're making it up.
I think everyone's making it up. So that's the range. The high is 452, the low 75. The median estimate is 298,000. You're all familiar with the previous read at this point. It was 528K. And equities, Tom, let's say they're going nowhere going into this jobs number.
There's been a churn there in the market. Even the FX market has pulled back a little bit from the excitement of the last hour as well. But I do want to say, John, as we talked to Priya Misra about, the bond market is speaking here. It'll be interesting to where it is in 7 minutes after this report's released.
Coming into this, the 2-year close to 350, the 10-year close to 325. Equities up by about 1/10%. The euro stronger, the yen weaker. Euro dollar 99.97. That currency pair positive 0.5%. And crude up by about 1.9%. Crude 88.26. The jobs report in America coming up next. Your estimate 298K. The data drops in just a minute.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
When you've had your fill of IPOs, ETFs, and CPI,
tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Payrolls in America seconds away, then seconds after that, it's Operation Get to the Beach. From New York City this morning, good morning. Equity futures positive 0.1% on the S&P 500. The NASDAQ basically unchanged. With the jobs data, here's Mike McKee.
Well, we got a number that's pretty much in line with what Wall Street expected. 315,000 jobs created during the month of August, with 308,000 of those coming in private payrolls. We'll have to look in a moment. There could be a big seasonal factor with teachers going back to work. So this could be an overall larger number in non-seasonally adjusted sense. Manufacturing payrolls up 22,000. We did see some strength in that ISM report yesterday. Average hourly earnings come in weaker than anticipated, 0.3% up, which means the average year over year is 5.2%, unchanged from last month, but lower than the 5.3 that had been expected. Here's an optimistic number for the Federal Reserve. The labor force participation rate rises to 62.4 from 62.1. So a significant number of people going back into the labor force looking for jobs, and that is something the Fed wants to see. The U6 underemployment rate, interestingly enough, though, rises to 7% from 6.7%. And I don't know if I mentioned this, the overall unemployment rate rises to 3.7%, and that would be a function of those people going back into the labor force. So let me take a further dive into the numbers here, John.
Sure,
and
do
you
that.
can take a dive into the markets and see how we're reacting.
It's pretty simple, Mike. Yields down, equities up. Yields at the front end down by 5 basis points to about 345. Equities up 0.6% on the S&P. On the NASDAQ up 0.6%. Dare I say, Mike McKee, that this might be called a Goldilocks jobs report through much of this morning. Just given what I'm looking at the moment, you've kind of got an inline payrolls figure. Unemployment's up, but participation is up, and wages are just a little bit softer. If the Fed had to design a jobs report this morning, Mike, would it look a little something like this?
It probably would. This is kind of what they're expecting, kind of what they're interested in. The unemployment rate rises because the number of unemployed people increased by 344,000, but it doesn't appear they lost jobs. It's like people coming back into the labor force who hadn't gotten jobs yet. So that's reasonably good news. The unemployment rate for adult men and Hispanics rose during the month. The jobless rates for women, teenagers, whites, blacks, and Asians, little change over the month. So basically, it seems to be a number of men coming back into the labor force that did not find jobs yet.
Critically, dollar gives way. Even the yen gave way after a 140.50 print. John, Mike, I'm looking at this, and the simple math right at the top of the Bloomberg study by Scott Landman and team is 315,000. Take away a 2-month revision of 107, gets you to 208,000 summary of one of the studies, the non-farm payrolls survey. Is this sort of, as John said, Goldilocks? Is this a back to normal report?
You could call it that, but we don't really know what normal is these days, because going into the pandemic, we were looking at 150, 180,000 a month or something like that. So at 315, we're still significantly higher. I might mention, John, that Tom talked about the 107 that you subtract for the revisions, and you asked me beforehand. I was wrong. July was not revised higher. It was revised lower, but only by 2,000 jobs. So most of that revision comes in the month of June. July comes in at 526,000. So still strength in these months. Will be interesting to see how much the jobs numbers change when we get the September report, how much August is revised.
Mike McKee, thank you, buddy. Just working through some of these numbers. Looking at the market reaction, it's pretty clear. Up 0.7 on the S&P, on the NASDAQ 100, up 0.8%. Yields a little bit lower at the front end. Tom, back to 345. We're down about 4 basis points on a 2-year, taking back some of that Fed angst for the September 21 meeting. And Tom, something I said moments ago, we'll see if this move sticks, but if you could get the Federal Reserve and equity market bulls to agree on something, on what a great jobs report might look like, if they could design one, Tom, I think this is maybe what they'd come up with.
Yeah, I agree with that, and I think it's the hourly earnings are way more quiescent than what we saw from ADP a couple days ago as well. And again, an equity lift here. The VIX from a 27 level in the angst of 2-3 days ago comes in nicely to 24.38. A few moments more with Randall Krosner. He's a former governor of the Federal Reserve System, math from Brown, and at Booth School, economics professor at the University of Chicago. Randy, I want to talk here about America's labor economy is being homogenous, where we talk about an all-in, say, 3.7% unemployment rate, or is it about the haves doing well and a good part of America flat on their back?
There is a lot of diversity in the labor market outcomes. I think you're exactly right. So this is not something that's even, but as you were describing, this is really what the Fed is hoping for. More people are coming back into the labor market. That helps to reduce the tightness of that market. And you saw that manifest in slightly lower wage growth, which is exactly what the Fed is hoping for, that more people will come in, relieve some of the pressures in the market, and take some of the pressure off some of the wage increases. So that'll make it easier for the Fed to try to bring inflation down to its 2% goal without pushing the economy too far down.
Randy, we've got the participation rate to that point at 62.4% then. How high can the Fed hope and wish and will that number to get?
Well, they'd like to get a lot higher. Maybe they'll get a little bit higher. I think it's surprising how much it hopped up. My guess is that it may not stay that high, or it might come down a little bit, but it's going in the right direction, which is exactly what we want to see happening to reduce some of the labor shortages, to reduce some of the pressures in the labor market. Because it's been a bit surprising, given how strong the labor market is, that a lot of people haven't been bothering to even look.
Randy Krosner, based on some of the takeaways, I think you're going to hear that word Goldilocks a lot this morning. Would you push back against that characterization of this report, given what you're expecting in the months to come?
Well, it's just one number, so we wouldn't want to go too far, but I think it's consistent with where the Fed wants to go. I think it has made the markets somewhat happy that, because I think they were worried that there could have been a blowout report here, and unfortunately, good news in the labor market can be bad news because the Fed will have to respond more, and so I think it's on a good path. But the Fed is still going to be debating 50 or 75 basis points, and I think we're going to end up by, very close to 4 by the end of the year, if not at 4, and then be, hold with a 4 handle through much of 2023.
Randy, thank you. Randy Krosner there of the University of Chicago. TK, hard to get excited about one data point, but on one data point, and it needs to be a trend, of course, to get any conviction about the future around this, but this is what I think that equity market bulls and the Fed might design if they wanted to call it a soft landing. Of course, Tom, that one data point doesn't prove a soft landing. You need a whole string of reports going well into next year to get us excited about anything like that.
The joke we've been doing today, John, good, bad, good, whatever it is, what this does is really push away a lot of the arch gloom that was out there. John, on Standard & Poor's futures, just printing 4,000 moments ago, and I want to give the dates here, and there's many dates back to July, back to June, then back to May of this year, and then you go back to a S&P 4000 of early April of last year as well. That's sort of where that fits into the continuum.
So we fade some of the Fed angst into September 21. Tom, that can change all over again on September 13th with the inflation report. Right. Mike McKee's had a second chance to look through this. Mike, do you want to jump back in quickly?
Yeah, one of the interesting things I notice is there are almost no real standout occupations one way or another. There are a few lost jobs, but very few lost jobs in categories, and no major hiring. I mean, we saw 18,000 people at restaurants, but that's nowhere near what it used to be. They're still looking for people, though. But the one area that you do see a drop is in the category of that includes mortgage bankers, mortgage brokers. They're down by 2,400 jobs. And that's also something you would expect because obviously the housing industry is in trouble. And so this is an overall strong report because it just has a kind of breadth to it, not any one particular category that's carrying it.
Whether gloom or optimism, we speak with Jeffrey Rosenberg of BlackRock, their portfolio manager for their systematic multi-strategy fund. We're thrilled he can join us each job day. Jeff, we need to recalibrate into next year. As John Farrow mentions, we need more data, but this seems to be one sigh of relief. Equity's up. How does the bond market have a sigh of relief?
Well, it's a sigh of relief, Tom, because you had a lot of expectations really following the Jackson Hole presentations, speeches both by Powell and Schnabel that were very hawkish with regards to central banks, definitively stating that they were focused on inflation. And so the setup going into today was a little bit skewed to the downside, that if it was a stronger report that would have only solidified expectations for the 75 basis points in September, and if it was a significantly weak report, then the market might have looked through that, as opposed to what we've seen, in the last couple of payroll reports, particularly over the summer rally. It had been a market that, hey, if we got bad news is good news. And it may no longer be the case that bad economic news and slowdown is really going to push the Fed off of its tightening cycle, because they've been so clear to tell us it's really about inflation. So I think the look through for today, Tom, is really about what does the report signal about any kind of inflation look through. And I think the labor force participation rate number is really the key takeaway that is the most interesting piece, as you discussed a minute ago with Randy, which is, a little bit better than expected news there, a little bit weaker than expected on the wage front. Modestly, that's good news from the bond market perspective of not having to see the Fed really react to inflation maybe as strong. Again, one data point, we're not going to overread that, but that's the one takeaway I would have from this report that I think is important, is the look through to inflation.
Okay, so I'll be in danger of overinterpreting one data point then, Jeff. With that participation rate, we've seen Fed swaps showing a pairing of bets on rate increases. Does it make sense then to expect less hiking from the Fed? And in what sense? Less hiking in the near term, or less hiking overall? Less hiking next year? What do we think?
Yeah, it's definitely about the near-term trajectory. I think what you're seeing in the markets today is about the 75 versus 50 debate. Today's number maybe pushes back a bit, and that's why you're seeing the rally in the front end of interest rates. But let's not overinterpret again one data point. This isn't really going to significantly change the trajectory of the Fed, and the terminal rate debate is still very much unsettled. And today's labor market report isn't really going to settle that debate. We're going to focus a lot more on the inflation and the inflation trajectory. A minute ago, Mike McKee mentioned some of the housing numbers. This is one of the big challenges here that we're seeing is a huge transition from home ownership to home renting, and that rental price is a huge component of that inflation outlook. Right. So those things are not really being addressed here on this labor market report, and that still faces the market still faces that uncertainty going forward.
And John Farrell, what's so important here, and you brought this up before, it's a key insight, is what do we really learn about where the terminal rate is for the Fed? The answer is this doesn't help us.
Well, look, at the end of the day, I think the Fed's been pretty clear. They want tighter financial conditions, and to some degree, that's going to cap the upside over the next few months, Tom, if they're not satisfied. And ultimately, the Fed's in control, and we've said it a million times over the last week. We've gone from a Fed put to a Fed call. The good news, I think, for a lot of people, just for now, if you bullish this equity market, this is a relief. Will it stick by the end of the day? We'll see. Futures rolling over just a little bit, positive 0.5%. I'll continue this conversation with Jeff's colleague, Rick Reeder. We'll do that at the top of the hour. Looking forward to that conversation. Also catching up with Victoria Fernandez of Crossmark, Michael Gapin of Bank of America, Jim Bianco of Bianco Research too, and Secretary Walsh of the White House, Tom, all coming up. Secretary Walsh about 9:45 Eastern Time.
Very good. John Farrell with the Secretary of Labor. We will look for that on radio and television. Joining us now, Jeff Rosenberg's still with us as well. We've got a great team lined up here to get you out over the next 17 minutes of this jobs report. Jeff, what are you seeing in flows? What's the fear level out there? I don't want to know inside BlackRock baseball, but are people selling bonds? Is money flowing out of debt?
Yeah, Tom, as you can imagine, the flows are highly reactive to the returns. And this has been a historic negative return year for all categories of fixed income. And we've seen that in the past week as well in terms of acceleration, in terms of rates higher, spreads wider. This is a very challenging environment for fixed income because we came into this year really pricing the old inflationary regime. And obviously the inflationary regime has surprised the Fed, it surprised the bond market, and we continue to see those surprises. And so until we get a sufficient inflation risk premium priced into the bond market, returns are going to be challenged. Now, the good news is you're starting to get more of that priced in, more of it priced into the front end of the curve. You talked a minute ago about the terminal rate. It's the back end of the curve where you still see a lot of confidence in the bond market that inflation will fall back to the 2% target. And so this is a bond market that gives the Fed an incredible amount of credibility. That remains to be seen, and that's a vulnerability to future fixed income returns.
Jeff Rosenberg, thank you so much. Really appreciate the valued time here on Jobs Day before a holiday weekend. Ira Jersey's scheduled to be with us here in a moment, but we wanted to squeeze this in. With all the gloom that's been out there, and certainly with futures up 17, the VIX in a stick 24.39, maybe a little less gloom than moments ago, but we wanted to talk to someone who has a framework of optimism about the American financial system, the American economy, and yes, stocks higher. Michael Purvis joins us from Tallbeck and Capital, always writing really intelligent notes. Michael, let me cut to the chase. What is the why and the how we get the Standard & Poor's 4,500?
Well, Tom, one thing that's been kind of working in the market's favor broadly, putting aside positioning and relief rallies and so forth, is that, the corporate earnings machine has been really performing here. Now, obviously, there are a lot of questions about whether that trajectory can be maintained into the end of the year and in particular to 2023. But look, nominal GDP is very high. It's the components of nominal GDP in terms of the weightings of inflation versus real growth are not what we want them to be. But we're still seeing high nominal GDP drives nominal earnings right there, and so we are seeing continued strength. If you look at Q2's reports, they came in, the surprise levels were better than they were in Q1 there. And on the other side, on the valuation side, look, we have had, you go through this massive Fed pivot over the last 12 months. It's been pretty remarkable, but it's also really well priced, and PE multiples and the equity risk premium by my measures have really calibrated appropriately here. So look, if we wake up and next week the 10-year's at 4%, which it won't be, but if it were to do that, then obviously we're probably going to see some further PE contraction and so forth there. But I think right now the markets are going along, and so I think we need to get through this September Fed meeting. We need to get through some, look, economic data is good. The unemployment data, is still really robust. The ISM we just got
maybe, Michael, what we're seeing here is markets responding or coming around to that view, because US 10-year yields, 30-year yields resume their rise. 10-year yields up to 3.27% right now. You talk quite positively about stocks and about the earnings story, but others say that the earnings need to catch up with reality, and that means that we need to see cuts to expectations around corporate profits. Why do you not see that?
Well, look, I think part of this simply comes back to nominal GDP being high this year and probably pretty high next year as well. My biggest risk to earnings next year, I mean, of course, if we get a big recession, yes, there's no question that will be a big hit to earnings here. But one of the other real risks for earnings next year is simply inflation coming down a lot. If that were to happen, a lot of the earnings will come in, and some companies will certainly see some margin compression there.
Michael, I want to give you a victory lap, Michael Purvis. We had Priya Misra on earlier with a call of the summer on curve inversion, and every once in a while, Purvis absolutely nails it, folks. A few years ago, Michael, you nailed ADXY, the blended Pacific Rim currency regime, ex-Japan. We now have yen through a new level moments ago, 140.80 on Japanese yen, many talking 145 weaker yen. Michael Purvis right now on what it means to see such currency weakness and strong dollar on the Pacific Rim.
Well, I think it's very significant. I mean, the fact is that the United States dollar, relative to so many currencies, the euro, but particularly the yen and many EM currencies, is sort of effectively a petrocurrency, certainly on a relative basis here. So, if you're talking about the yen, you have to consider hydrocarbon vulnerabilities, and they're as painful as oil prices are here. It's a lot less so than it is in places like Japan and the Eurozone. So I think there's that, if you tell me, Tom, that oil's going to 150, I can't imagine how the yen wouldn't get a lot cheaper or the euro get substantially cheaper relative to the dollar here. So I think that's one of the weird dynamics, is that oil is leading, is a key thing that's driving, that's leading currencies around by the nose.
And does that lead to a change in BOJ policy, Michael? Is that where this leads?
Well, I guess we've all been waiting for that for some time. I think there's certainly an interesting sort of game of chicken the BOJ has been playing here. We'll see at what level of sensitivity they have, but I think they're, after 3 decades of very, very considered deflation, disinflation in Japan, maybe that they feel this is what it's sort of needed to kind of wake up the economy there. But it is a dangerous game. I think they're playing at some point.
Michael Purvis, thank you so much. Greatly appreciate it there. A real optimism on the equity market, and we're seeing it right now with futures up 20, Dow futures up 149, the VIX in 24.37, and this off a little higher unemployment rate. Michael McKee, I want to slip you in here very quickly. One more insight right now, quickly.
The idea that people have come back into the labor force makes a big difference, because when you look at the average hourly earnings, June was revised down a little bit. So for 3 months months now, we have seen flat or falling hourly earnings. They're still high, but they're coming down. So this is a very Fed-friendly report.
To get this in with Albert Nardelli, Yura Kosova, and Michael Nenebauer on G7 backing a price cap plan for Russian oil to limit revenues. How will Europe greet this, Anna Edwards?
This has been something that Europe has not been on the same page as the US on. Certainly Germany had their doubts. They wanted Turkey and India to be part of this. So to Jack Fitzpatrick's point earlier on, the European response might rely on how the rest of the world responds.
Let's go to Ira Jersey right now. We're jumping around here in stores, and I really want to leave some time for Anna Edwards on the politics of London this weekend. Ira Jersey on the bond market. John Farrell was talking about this is the report the Fed wanted to see. Do you agree?
I think generally yes. So the idea is that the wages are slowing. The job market though is still okay. So this is maybe leading us toward a soft landing. But of course, I think the market is certainly taking it a little bit as a Goldilocks report, where you've had at least a knee-jerk reaction has been for people to buy the front end a little bit and sell the long end. So you do have a little bit of curve steepening right now, and signaling that maybe we're not going to have as hard of a landing as the market was pricing just before the report. And maybe not as much hiking. Is that the conclusion? I note that one piece of research drops into my inbox says 75 basis points is still on the table. You think so? Yeah, I think 75 is still on the table. The inflation report, I know you had Jeff Rosenberg on a little bit earlier, and he mentioned, look, inflation is really what the Fed's trying to fight here, that this is one component, and obviously an important component, winds up being wages and the health of the overall economy. But the inflation report will be incredibly important for whether or not the Fed goes 50 or 75. To my thinking, though, this doesn't necessarily change where the terminal rate's going to be. So how far will the Fed go? Because even if they go 50 in September, we don't know what they're necessarily going to do in November or December, right? So if they go 50 each of those, then obviously we're going to price for higher terminal rate. We were just about starting to price for the terminal rate to be above 4%, and we backed off just a little bit from that this morning. But we're still talking about another 100 to 150 basis points of hikes here by the Fed over the next couple of quarters.
Ira, we spoke to Randy Krosner earlier. He was cautioning that the lag effect here is 6 to 18 months. What does that mean when we look at this jobs report? This is reacting to Fed policy a while back.
Well, it might not only be, quite frankly, it might not only be Fed policy here. We're the higher inflation and higher input costs for some companies. We were talking about things like corporate earnings. You just had Michael on talking about that a moment ago, and the thing is that you might slow down the pace of wage growth, and then you might also slow down the number of people that you're hiring overall, and those things will obviously slow down the economy in general. And again, this one report and last month was incredibly strong, so we still have to see a few more data points before we can make any conclusions.
Quickly, Ira Jersey, what is a normal 10-year real yield? Is it 100 basis points? It's been so long, I don't remember. What's normal?
Well, I don't think there is really a normal. Real yields have trended lower for 40 years, so we're kind of making new real yields here. I think a real yield somewhere between 50 and 100 basis points on 10-year tips is probably what I would consider a neutral range. I think the risk right now, and something that the market needs to see, is even higher real yields in order to slow the economy just enough to get inflation much lower.
Ira Jersey, thank you so much. With Bloomberg Intelligence, he will publish today, so you can read it on Monday and Tuesday in America. Mike McKee, one more insight quick.
Yeah, a couple of late statistics here. Labor force prime age participation rate reaches 82.8%, highest since before the pandemic. We also have 12,852,000 people working in manufacturing. That's the most since 2008. So manufacturing doing very well. And then we mentioned seasonals earlier. Only 6,000 added. So seasonals were not a factor.
Okay. I don't care. Am I prime age?
Can I take the Fifth Amendment here?
Okay.
Or I'll just kick that over to Anna.
Anna Edwards with us. And we're going to finish strong here with someone that is truly devoted from Brexit on and before Brexit to the strange politics of her United Kingdom. Anna Edwards, our heads are spinning. Who are the tiny, tiny group of people that anoint your next prime minister?
Right. Well, it's the Conservative Party membership, and that is, yeah, a subset of the voting public, a very, very small subset of the voting public. They tend to be whiter and older than the average here in the UK. But they make that decision. Many of them have made that decision already. We get to find the results.
Right.
When you're on a holiday, I think, Tom, on Monday.
We talk about the first Tuesday of November. When does Labour get to participate in the election process?
Well, that's an interesting one, because officially not for another year, 2 years into 2024.
How can that be?
But whether there could be, well, we had the last one in 2019. Do you remember? That's the one that Boris Johnson won, and so then there's 5 years to the next one. But we could see the Conservative Party decide to call an election before then. They can try to do that, but there are rules.
There are rules as well. What is the distinctive difference from where you sit, Anna, between Truss and Sunak? What is that distinctive difference for these 12 people voting on them?
Well, a lot of, yeah, a few more than 12, but I get your point. A lot of it comes down to tax. Liz Truss has been promising not to increase taxes. She wants to cut taxes. There's concern what that does to the public finances, what that does to interest rates in the UK as well. Sunak has suggested that he doesn't like her economic policy. So there is a big divide. Also, Liz Truss, and this is crucial, has set about wanting to at least address whether we need a new mandate for the Bank of England. So that'll be something people are watching by Monday, Tuesday.
Anna Edwards, thank you so much. And thank you so much for joining us for the last 2 days as well. Of course, Anna's promised that on our next road trip to London, she will join us to watch the Tots play at, north there of London.
This is a football reference, I think.
We will see football reference as well. Yeah, it's the Tots.
Okay, good.
Let me go through the market here, folks, to prepare you for the rest of the morning and really driving towards John Farrell's important conversation with the Secretary of Labor. Futures off of this jobs reporting critically the negative revisions, bringing the big number down to, sort of a smaller look-see here is maybe what the Fed wanted. We went from 315,000 and you take away a negative 107 of revisions. So it's a 200-ish number. That's what they liked in the markets. Futures up 25. Dow futures up 180. SPX back to a 4,000 level. The Dow a bit under a 32,000 level as well. I'm just saying that to aggravate John Farrell. The VIX 24.21. We hope you enjoy your Labor Day. This is Bloomberg. Good morning.
Tom's already on the way to the beach, live from New York City this morning. Good morning, good morning. We've got a lot to talk about. Equity futures positive, just about up 0.7% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
From New York, we begin with the big issue. It's Jobs Day in America and payrolls top estimates, giving the Fed the green light to keep on hiking. Mike McKee joins us around a table for more. Good morning, Mike.
Good morning, John. And you got to believe that at the Fed, they really like these numbers. It keeps the soft landing narrative possibly alive. 315,000 jobs created in the month of August, 526,000 in July. So that's only a revision of negative 2,000, negative 107,000 total. That comes out of June for the most part, and that has implications for average hourly earnings. The unemployment rate rises to 3.7%, but that's a good news story as well, because it really is because we saw more people come into the labor force, not that we saw so many people losing jobs. 62.4% is now the participation rate. That's up significantly from 62.1%. The prime age participation rate has gone up to 82.8%. And John, that is the most since 2020, before the pandemic. Average hourly earnings, I mentioned, up 0.3% on the month, lower than anticipated. Keeps the annual rate at 5.2%, also helped by the fact that June was revised lower. Jobless story, I mentioned 3.7% overall for Black Americans and Hispanic Americans, 6.4% and 4.5%, slightly higher. The U6 does jump up to 7%, more people in the labor force. The household numbers, you can see there, specifically influenced by that labor force number, 786,000 people looking for jobs. And you can tell the story with one chart, and that is basically that the labor force is almost now back to where it was before the pandemic, and that is pushing up on the participation rate, and that is flattening out average hourly earnings. And that's what the Fed wants to see. If we're seeing growth and we're seeing employment strength, but we're seeing wage growth slow, then that keeps that soft landing possibility alive, as I said.
Alive, but Mike, does it change the 75 call on September 21 for this Fed?
I would suggest this leaves it right where it was, somewhere in the middle. I'd be interested to see what futures price. We do have that CPI report coming on the 13th, and that will be dispositive, as they say.
Mike McKee, thank you, sir. Great lineup today. It starts, as always, with Rick Reeder of BlackRock. Rick, let's get straight to it. What would you call this one?
It was a good number. I mean, it gives the markets a chance to take a little bit of a sigh of relief, and the Fed a little bit of a sigh of relief. You know, we had a pretty potent week in the market of look at the aggregate index was down 150 basis points. The S&P was down 4%. Tech was down 6%. You know, this number, we're seeing pressure on real rates, concern the Fed has to move faster. I still think the Fed's going 75 basis points this meeting, but it gives you a little bit of, we saw, I think claims data was solid this week. The job openings were surprisingly higher. Listen, the labor market's in very solid shape, particularly the service sector. And the fact that today was showing a little bit, it's coming off the boil, it's softening a bit, I think is encouraging. And it gives you a little bit of comfort that, what the markets were reacting to earlier this week, maybe a little bit more moderate.
Rick, the Fed talks about the totality of the data. As you mentioned earlier this week, ISM manufacturing better than expected, jobless claims lower than expected, consumer confidence firmer than expected. Good news this week has been bad news. And Rick, do you think that's going to be the case for the time being? Because this Fed wants to keep financial conditions tight.
I think that's right. I mean, listen, I think the reason why this number is so important is the conditions for employment are so significant. Can you, and by the way, I don't think a soft landing is that hard a needle to land the plane on. And if these employment numbers moderate a bit, I think it's pretty good news. But listen, the economy, it's hard to argue. And by the way, the deep recession stuff is ridiculous. The economy's in pretty good shape, and particularly the service sector is moving along quite nicely. A good sector is coming under some slowdown, which is anticipated. And but the economy's in good shape. And when you cut across the numbers, I was looking at it again this morning.
Sure.
It shows an economy that's moderating, but certainly not slowing that much.
Rick, you don't sound like a man carrying a lot of cash. If these are the kind of things you're thinking, that the runway for a soft landing is not that narrow, et cetera, et cetera. So what are you doing?
We are sitting on a fair amount of cash.
I know,
but we brought that. We talked about it. We talked about it last month on your show. We've let the line out a little bit, and have been buying. And particularly, John, one of the things that I think is quite different is now you're pricing in the front end of the yield curve. You've got almost 75. You got 65 basis points priced in for the September move, then 50, then 25. That's what I think the Fed's going to do. I think they're going to go 75, but it's priced in. The front end of the yield curve, all of a sudden you get 3.5% in the 2-year note. By the way, put some spread on it, and quality assets, the spreads are attractive in quality assets. You can get a 5 staying in high quality. So we've been doing some things about, gosh, let's start buying some quality assets in the front end of the yield curve. By the way, I think the longer end of the yield curve, not that interesting anymore. And I could see rates move higher in the long end. But boy, I think the front end's priced in an awful lot. And as long as the CPI report, as long as the inflation data continues to moderate, you look at what's happening, gas prices coming down. Boy, I think the front end getting close to 3.5% is the 2-year 3.5%, and with some spread. So we've been using some cash and buying some front end quality assets, and anticipating on any backups doing more of that.
So Rick, where does that leave your view on the long end then? You mentioned it briefly, 325, and I've got a long list of people that I've been writing their names down who think we've seen the high of the year. Do you disagree with that?
Yeah. So, I think it's hard to mark down this is the high of the year, but Jonathan, I think this is we're in a range. And if you said to me, I still think we're in the upper end of the range. You know, if you take where inflation break-evens are for 10 years, and you lay at about 2.5 and just under, and you look at, you know, gosh, you're putting a full almost % real rate on top of that. You know, that's pretty that's pretty attractive now that you're getting to real rates, or maybe 75 basis points of real rate in 10s. You know, that's pretty reasonable. So do I think, you know, we're in a range? I think we're in a range. Do I think we're in the upper end of the range? I think so. I think rate volatility in the longer end of the curve will start to come down, and you can be comfortable selling some you know, what we call high strikes, or selling significantly higher interest rate puts on significantly higher interest rates, because I think we're at the upper end of the range. But I think it's pretty hard to say we've seen the highs currently.
We've worked our way through asset classes. Last month was brutal. Equities down, treasuries down, commodities down, corporate credit, high yield suffered. Spreads are back to 500 basis points, there and thereabouts on high yield. Rick, when does that start to get interesting again for you guys?
So, I mean, quite frankly, I like running, you know, a bit of a barbell in that, you know, I'm talking about quality assets in the front end, get some yield in the front end. Boy, if you can get 5, you know, why take the risk, take much more risk? Why take a lot of equity risk, quite frankly, in an environment where the Fed's still tightening financial conditions? You know, I think it's worth owning some credit. You know, these yield levels, you look at that spread, then you put on top of where the risk-free rate is, you know, you can get 8.5% type of yield. Boy, those are pretty good break evens if you believe in a soft landing, which I do. So I think credit is okay. You know, where don't I love? You know, I still think you got to be a little bit careful in emerging markets. I think you got to be a little bit careful in real estate related assets today, particularly residential. And, you know, listen, Europe's in a tricky spot today when you look at that inflation data we saw this week, both across the UK and the Eurozone. So, you know, owning some U.S. credit and particularly owning some quality assets in the front end, that strikes me as some of the more attractive places to be for now.
Rick, can we just wrap this up with just one question and revisit the conversation we had a couple of minutes ago? You believe in a soft landing, but you're carrying a lot of cash.
Mm-hmm.
Rick, why is that? Why are you still suggesting to people that they do the same?
So I am suggesting people do the same because the Fed's tightening financial conditions and they're going to continue. I mean, this number, you know, was a little bit softer, but boy, I don't think it changed the paradigm of we can go 75. By the way, they're trending liquidity. You'll see more of that play out in September. You got a lot of supply coming to the markets as the markets quote unquote reopen in September. So boy, I don't think the opportunity set has yet presented itself in full yet. So listen, I still think vol is going to be high in the markets.
Yeah.
And I think the risks that we still trend down, particularly down the cap stack in places like equities. So I still think holding some. And by the way, you know, you can hold some cash and own some front end assets and still carry pretty well through a time where the Fed's still moving. And by the way, not just the Fed, the ECB is moving, the UK is moving. So I think there's a point in time if you can get enough carry and some yield in a portfolio without taking a lot of risk, why not?
Hey, Rick, just awesome. Your buddy Jeff Rosenberg was on the show about 20 minutes ago. He was in shorts. He was already going to the beach, I think, as soon as that interview ended. Go catch him up. Rick Reeder, thank you, sir, as always.
Thank you.
It's good to see you, buddy. Futures up 8 or 9/10 of 1% on the S&P 500. We're bouncing back here. Let's continue the conversation, extend things with Crossmark's Victoria Fernandez, Jim Bianco of Bianco Research. Hey, Victoria, good to catch up with you. Walk me through it. Your take on the jobs report 40 minutes ago.
Yeah, well, Jonathan, I mean, I think when we look at it, the market is pleased with the number. It wasn't too hot of a number. I mean, there was the expectation that we could get a lot more. Look at St. Louis Fed. They were saying maybe north of 500 on the number. So I think the market is relaxing a little bit. We had a quick knee-jerk reaction higher. We've seen that come back. We've seen yields move a little bit. I think this tells us that they really don't have an answer to the September meeting. Maybe people thought they would get it here, but I don't think we do. So they're continuing to see 50, maybe 75 basis points at the meeting. I think the most important component, Jonathan, of this is the participation rate. And Mike was talking about it earlier. You know, the Fed wants to see the labor market weaken, but we don't have to do it by destroying jobs. We can do it by bringing more people into the labor force. And I think this was a good start to seeing that happen. I think we need to watch that. That will control wages. That's going to be a big component of that sticky inflation. So we need to continue the trend with that.
Jim, what do you think?
Yeah, I'd agree with most of what Victoria said. And what I'd add is, you know, last week we got an 8-minute speech, and Chairman Powell was very emphatic at Jackson Hole that they were going to fight inflation. this number shouldn't really change that. It's not going to change it either way. And that's why the market is now pricing still better than a 50% chance that the Fed is going to move 75 basis points. So I think when you put it all in the mix and you stir it up, I think what you come out with is, unless the CPI data or the stock market has a giant move in the next 2 weeks, or either way, it more and more looks like we're going to get a 75 basis point hike on September 21st.
And Jim, that's the struggle at the moment for a lot of people in this market, that even if you take the constructive view from this one data point and extend it out, Rick Reeder of BlackRock was on moments ago and he talked up a soft landing. He believes in a soft landing, but he still doesn't think we've seen the end of it in this market, Jim. So apply what you think about the economy to what you think about the market. How difficult is that to reconcile the two at the moment?
It's very difficult, and I think the reason is because we all are focused on the economy, and we want to know whether or not there's going to be a soft landing or not. But the Fed is focused on inflation. The economy could just sit there and it can do what it wants. Look, we had 2 negative GDP reports in the first half of this year. Didn't stop them from raising rates 200 basis points. So I think really what we've got to do is we've got to pivot away from the economy, focus on the inflation story. And the Fed is committed to raising rates till we get to 2%. That's not happening for a long time. So I think when you do it when you look at it in those framework, it makes sense that they would hike 75 and they would stay very aggressive. And I think that's what the market's trying to sort out right now.
And they want to keep financial conditions tight. So Victoria, with that in mind, even if you can take a constructive view on this jobs report we've had, and maybe even on the future, and there are some optimists out there, I struggle to find them, but they exist. If you see pops like this one, have we gone from buy the dips to sell the rips? Is that the play now?
Well, I'm not sure that that's the play at this point. I mean, we've got the inflation numbers coming out in a couple weeks, and to me, that's going to be key, probably more important than the jobs report that we have now. The Fed is going to be watching that. And look, you've got an economy that has some strength. If you take everything else out about what the Fed is doing, and you look at an ISM where you've got new orders and employment moving higher, you have supply side constraints diminishing, you've got an unemployment rate at 3.7%. Nothing there tells us that we're in a deep economic concern or recession is imminent. So I think you need to balance your portfolio with that. Find those names, those quality names that have good earnings, add them to your portfolio on down days. I don't think there's anything wrong with that, but you can still take a little bit of a defensive position with some healthcare names or with some staple names like we're doing. But I think you still need to be in the market because the economy is still strong.
Victoria, Jim, sticking with us. Let's see if this move sticks. We're fading at the front end. We're down about 6 basis points to, let's call it 344. Blasting higher on equities. Equity futures up by about 0.8% on the Nasdaq, up by 0.75%. It's a difficult moment. The Fed's told you it wants tight financial conditions. We all know we've gone from a Fed put to a Fed call. Will that keep a lid on things? We'll find out by the end of the close, I guess. Let's get you some movers going into the open. Here's Abby.
Well, John, on this Goldilocks jobs report, we, of course, have yields, as you were just mentioning, coming in. That's helping out big tech. Apple, which ahead of the report had basically been flat, is now popping sharply higher, up 1.1%. Broadcom, the chip maker, also higher. It's not just this report, though. They put up a good quarter. They also gave a strong forecast. So a nice reprieve in terms of other chip makers struggling. Their bookings were strong. Lululemon up nearly 11%, a big beat. They boosted their outlook. It looks like there's a lot of brand loyalty there despite the inflation picture. And then finally, rounding it out, oil, of course, rebounding. Occidental Petroleum outperforming, up 3.2%. Of course, Warren Buffett's Berkshire Hathaway owns 20%, so Occidental Petroleum tends to outperform the energy complex. A very strong mover on the day, John.
Abby, thank you. Coming up, global bonds falling into their first bear market in a generation.
This is about global interest rates. The fact that we've had a big move in bonds, in gilts, you name it, the global bond market is repricing higher.
That conversation up next.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Names at the Fed are on Bloomberg.
It is essential we get inflation down. People want jobs, but they also want low and stable inflation. We have to give them both.
Nobody covers the Fed like Bloomberg, your global business authority.
We've been worried that the market was too optimistic and that the reality was going to set in. That's exactly what we're seeing.
We are seeing a meaningful sell-off in global bonds. This is about global interest rates.
Fundamental repricing.
Repricing higher, I think, to the global central bank community that's willing here to risk a recession just to fight inflation.
Return from artificially low rates to a more normal bond market environment.
I do think the longer duration bonds have further to fall.
I still think that we have seen the yield peaks for the cycle.
Momentum is probably going to continue to push yields higher.
It's certainly going to be an interesting next 2 or 3 weeks in the run-up to the Fed.
It's been fascinating. We've said that more than once. Global bonds now falling into a bear market, falling more than 20% from their 21 highs, with central banks doubling down on their commitment to tame inflation. Taylor Riggs with us for more. Hey, Taylor.
John, you know the math. Bond price down, yields higher. That has been the name of the game, and we finally get it when you take a look at sort of the global bond market. That terminal chart there about really falling now about 20% from the latest peak, as you can see. I wanted to focus on the U.S. as well because it has been sort of a huge movement on the front end of the yield curve. In the last month, 2-year yields are up 43 basis points to starting to get closer to that 350 level, the highest since 2007, as we've talked about. And then further out on the yield curve, I'll point you down to the bottom of the screen on a 30-year yield that still manages to rise 37 basis points. So this feeling of more hikes on the front end, slowing growth on the long end isn't actually playing out. We're really seeing almost a parallel yield curve shift all across the curve. When you dive down underneath sort of the surface, you're getting sort of a regional composition here, if you will. North America, of course, as we've talked about, you're off about 12% or so. You get a lot of LatAm. Europe as well is sort of the big decliners. Eastern Europe, when we think about sort of the big yield moves higher and some of the big prices lower. Overall, that gets you to sort of those almost double-digit declines that we've seen.
Taylor Riggs, thank you. Looking at the bond move right now, yields backing away. We're now down 7 or 8 basis points at the front end, 342 on a 2-year. Looking at the equity market, a lift again, up almost 1% on the S&P 500. Mohammed Al-Arian weighing in on Twitter and saying the following: something for everyone in the jobs report today. He goes on to say the economic outlook benefits from continued solid job creation and higher labour force participation. The Fed will welcome muted wage growth and the uptick in unemployment. Markets will see this as warranting diminished hard landing concerns. Connor Senna, Bloomberg Opinion, also out on Twitter right now. He says the following: we're a soft CPI report away from markets saying Jackson Hole and Kashkari on Odd Lots, the podcast hosted by Tracy Alloway and Joe Weisenthal here at Bloomberg, was peak hawkishness. I want to get to Jim Bianco on that. Jim, we made the mistake earlier this summer saying peak hawkishness, Fed pivot. Are we at risk of making the same mistake again?
Yes, we are, unfortunately. I know a lot of people are having a hard time understanding what I said earlier. Fed is looking at inflation, 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 the economy. And as long as the inflation numbers stay high, and high is defined as anything over 4%, they're just going to keep going. And they couldn't be possibly more clear. And you're right, Neil Kashkari saying he was happy to see the stock market sell off as hard as it did. They're not going to crumble on one week CPI report in 2 weeks. If they did, they blow all their credibility. So I know that this has been the story of this year, is the Fed talks hawkish, we say they don't really mean it, and then we're surprised when they do mean it. And unfortunately, that song continues.
Victoria, why do you think we're struggling so hard, so much, to internalize that message that Jim just conveyed?
Yeah, well, I think there's been a lot of credibility issues around the Fed for the whole year. And so now that they come out and they say, no, really, this time we're telling you the truth. This is what we're going to do. We're going to keep our foot on the gas. We're going to continue to raise rates. We're going to get to that terminal rate of 3.75, 4%. Mester, I think, even wants to go higher than 4%. I think it's hard for the market to believe that when they're seeing things like commodity prices come down, when they're seeing supply side constraints start to ease. So it's hard for them to put the two together along with a stronger economy. But I'm with Jim. I mean, look, when we were having client calls at the end of the last quarter, we kept saying, don't believe the story of the pivot. They're not going to pivot. They are going to continue to raise rates. And so we think people need to adjust to that story and believe that they're going to do that. Can they do that elusive soft landing? I think they can because of the strength of the economy, because of the labor market, because of the consumer balance sheets. We have the ability to do that. But I think we need to believe the Fed, and people are having a hard time doing that right now.
A super difficult time, and it raises questions about the sustainability, the durability of the bounce on my screen right now. Victoria Fernandez, Jim Bianco will stick with us through the opening bell. We come down about another basis point at the front end. We're down about 9 basis points to 341 on a 2-year. In the last 24 hours, we've pushed through 350. We've backed away now. As we back away at the front end of the yield curve, equities have a pop, up more than 1% on the S&P 500. Coming up in the morning calls, and later, Bank of America's Mike Apin joins us at the opening bell. Plus, we'll hear from Labour Secretary Marty Walsh on the jobs report. Looking forward to the view from the White House in the second half of the programme. From New York, this is Bloomberg.
A landmark climate bill passes through Congress. The expansion of nuclear energy and more investment for companies at the forefront of the fight against climate change. In this episode of Bloomberg Green, we'll explore President Biden's climate bill.
I almost think there's no superlatives that capture the breadth and scope and scale of this law.
Find out what's actually in it and where it doesn't go far enough.
The thing that's not included here is a specific hard cap on CO2 emissions or a specific legislated goal.
And look at what more needs to be done to invest in modernizing and greening U.S. infrastructure.
What we haven't had is a plan that's realistic, time-bound, pragmatic.
I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Yields down, equities up for now at least. We'll see if it sticks. Equities up by 0.9% on the S&P on the Nasdaq. That's your price action. Here are your morning calls. First up, JP Morgan downgrading Dow Inc. to neutral, anticipating headwinds from rising rates and a slowing global economy. Your second call from Guggenheim, upgrading Salesforce to neutral, highlighting an attractive risk reward following the stock's 20% decline. And finally, Piper Sandler raising its Tesla price target up to $360, expecting higher prices and improving supply chains to drive shares higher. We're positive there. 1.71%. Coming up, Bank of America's Mike Gapin at the opening bell on why he thinks we still get a hard landing and not a soft one. Plus, the view from the White House. US Labour Secretary Marty Walsh reacting to the payrolls report from the White House. That conversation just around the corner. Live from New York City with futures up 0.9%. Your cash open next.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
Ken Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
24 seconds away from the opening bell this morning. Good morning to you all. Equity futures pumping higher, up almost 1% on the S&P. On the Nasdaq 100, up about 0.9% off the back of a job markets report that has got a few people saying the word Goldilocks, although it's winded some people up out there, I know. But off the back of that, yields down at the front end, support in equities for now. That's the opening bell. Switch on the board and check out the bond market. Yields on a 10-year shaping up as follows: down 3 basis points on a 10-year. They're 3.2234. If you check out the front end of the yield curve on a 2-year, we're down 8 or 9 basis points to 3.41. Bit of dollar weakness out there against the euro through much of the session. Euro dollar positive 0.6%, just above parity. Going into next week, the ECB on deck. They're still looking at 75 and potentially tightening into a recession. That gives you an idea of the kind of backdrop we're discussing right now and why so many people will just say that labour market report changes nothing. Bigger things are happening here, worldwide, and not just here in the United States. Yields down then, 8 basis points, equities up, crude positive. Let's get you some movers. Here's Abby.
John, well, on that story of yields down on that sweet spot payrolls report, we do, of course, have big tech rallying because those shares look less expensive when yields come in. In addition, Microsoft is being helped out well off of its highs, up now right about 0.2%. That dollar in, though, as you were mentioning, of course, they pre-announced weeks ago on FX effect, but right now moderating those gains. Broadcom, on the other hand, up 4.2%, not only helped by yields in, but of course, they put up a strong quarter, a solid outlook, booking strong, so a bit of a reprieve for the chip sector. Interestingly, even though yields are in, we do have the banks higher, JP Morgan up 0.9%. This has to do with the yield curve, of course, steepening, less inverted, so again, some strength for the banks. And then one of the top sectors on the day, as you know, John, energy, ExxonMobil participating up 2%, in line with oil's gain. And again, energy is right now the second best sector on the day.
Abby, thank you. Everybody weighing in on this one, including 22V's Dennis Duboucher. He says the following: this is a positive for risk assets on the day as it reduces the odds the Fed has to push rate hike expectations even higher. That being said, demand appears too strong still for the Fed. That limits the upside on this number. Taylor Riggs has more. Hey, Taylor.
Hey, John, and like you said, sort of the risk on asset that you see on an intraday basis, that, of course, really being confirmed in the note that you read. You have equities higher, yields are falling, dollars weaker. So maybe that's sort of an interesting change of a market, maybe not believing a lot of that hawkish rhetoric. I think what is so interesting, if we take a step back and think about where we were around June 14, we've gotten those 275, so that gives us 150 basis points. You have a 2-year yield, though, John. You're only up 7 basis points. Spreads are up a little bit, but only 17 basis points, and an equity market that's rebounding. So is this sort of the delayed effect of a Federal Reserve where we're not quite seeing the tightening yet? Will we not get that till Q4? Is this the Fed that has to go more because the market isn't giving the kind of reaction that typically we'd like to see? That's certainly something that we're going to be diving into and digesting in the closing bell, too.
And there's the promo for this afternoon. That's the fee for Taylor Riggs. Taylor, we appreciate it. Looking forward to the close a little bit later. As you all get ready for your long weekend, we caught up with BlackRock's Jeff Rosenberg. Truly, he was wearing shorts and he was ready to go to the beach after the payrolls report. This is what Jeff had to say before he headed to the exit. Take a listen.
What does the report signal about any kind of inflation look through? And I think the labor force participation rate number is really the key takeaway that is the most interesting piece. That's the one takeaway I would have from this report that I think is important is the look through to inflation.
Pleased to say that with us now is Mike Gapen of Bank of America. Mike, great to have you with us, sir. Let's start straight off the top with the jobs report from now 60 minutes ago. Your thoughts on it?
So I agree with Jeff. First of all, I'm not in shorts. You can see I'm in the office. I agree. The key statistic here is that labor force participation rate number. What I think it does is it opens the door for the Fed to slow the pace of rate hikes beginning in September. And then I think you have to balance that with there's enough overall momentum in the economy to say this may not change where the Fed ends up, but it probably reduces the risk of another large rate hike in September. So I think the combination of that bounce in participation, softer average hourly earnings, as well as a tick lower in hours, you know, it signals that some of the tightness in the labor market may be ebbing.
Mike, what's more important here, though? What they do in September, or the fact they've communicated that once they do start to pause, they're going to be holding for a long, long time?
No, the latter, and that's clearly, again, I don't think this report changes where they want to end up or where they anticipate ending up, but it does, I think, mean we can get there in a path of rate hikes that are more a combination of 25s and 50s than, say, 75s or even risking a larger 100 basis point hike. So that's really all that I'm suggesting here, is that it opens the door to a slower pace of hikes. So the key statistic in my mind is the labor force itself. The size of the labor force for the first time has now risen above pre-pandemic levels. That has to give them at least a little comfort and suggest that maybe the labor market isn't quite as off balance as they thought.
What does it mean for your hard landing call?
Look, I'm still of the view that at the end of this, you're likely to get something that's more of a hard landing than a soft landing. Soft landings are hard to achieve. History says Fed tightening typically comes with some slowdown. And it's just my view that the unemployment rate needs to rise more than just a few tenths in order to help bring overall inflation lower. So I'm still in the mild recession camp, despite that this is a report that kind of goes against that view, at least in the short run. So my overall outlook hasn't changed. It's just, I think it reduces the odds of of a large rate hike in September, which provides some comfort on the margin.
Mike, what's the character of that hard landing? What is the character of it? We've got unemployment right now at 3.7% off the back of that higher than expected participation rate. And the Fed has got unemployment at 3.7% year end, and at 3.9% year end 2023, and at 4.1% in 2024. Do you think they're too optimistic?
Yes, I do. So I would say the character is more like at least a percentage point and a half rise in the unemployment rate. So that would qualify as some pain and some softening in labor market conditions, to use Chair Powell's term. But by historical standards, that would be an unemployment rate that's still around 5%, maybe a little below, which is low by historical standards, and why I would call it a mild recession in that case. So yes, is it possible to get a soft landing? Sure. And the quickest way to a soft landing would be a big, large rebound in labor supply, what this report suggested. But will it continue? I suspect the Fed has more work to do and needs to moderate overall demand, and that's going to involve more pain in labor markets.
And they clearly think that too. Final word, Mike. September 13th, CPI. What are you and the team looking for?
Kind of a repeat of last month, where energy prices provide a break at the headline, and some indication that these big durable goods prices like used cars are indeed softening. So some of the incoming data there suggests we should get help both in some reversal in prices of large durable items like used cars, new cars, household furnishings, and then gasoline prices giving us some relief at the headline.
Mike Gapin of Bank of America. Mike, great to catch up. Thanks for being with us, sir. Enjoy the long weekend stateside. Victoria and Jim back with us for a final thought. Jim, you and I have gone back and forth over the last few months, and you know the theme I want to pick up on, the new consensus. Last year it was transitory. This year, you've heard it a million times, we all have. It's short and shallow. We'll get a recession, but short and shallow. Are you pushing back against that?
Yeah, I think so. I'm going to agree with Michael that the history shows that the Fed, a soft landing is what we call it before it becomes a harder landing. For the Fed to bring this plane in a soft landing would be extraordinary, especially given the volatility that we've seen in inflation. All the signs would point towards something to be a little bit more difficult than we're all hoping. Today's employment report was a good step towards a soft landing, but it's only just one report.
Victoria, your take on the same thing?
Yeah, I don't think we're going to see a recession this year. I think we get a soft landing. But when we look into next year, look, we are not in a bubble in this global economy. We've got less than a third of global PMIs in expansion territory. So I think at some point that is going to feed through along with higher rates and hit our economy. We're looking more towards the middle of next year for the pain to really hit.
That's the tough point. I'm pleased you brought it up. It's got to be Europe. It's got to be China for that matter as well, Victoria. Saw another city shut down yesterday in Chengdu. It was Chengdu of about, 21 million residents, Victoria, in China. The difficulties out there in the global economy, when do you expect to see that show up in the earnings of some of these big multinationals? And I'll go a step further. Given the tightening of financial conditions here in the United States, we need to think about the tightening of global financial conditions. With the inflation backdrop in Europe, that's not at a peak. A lot of people think that's still in their future, not in their past. What does all that mean for how things look here in America? What's the spillover effect look like?
Yeah, I think you're looking into next year, and you've got to think when you look at the energy concerns that are in Europe. I mean, Europe is about 24% of our exports. They're not going to be able to have high demand there. And you look at China and they're exporting. They're not going to be able to do that either with a lot of their factory shutdowns that they're seeing. So as global demand declines over the next 9 to 12 months, obviously that's going to have to flow through to us. And that's where we see more of the concern. Not this year. We will have a small growth recession. That's okay. The economy's strong enough to handle it. But you let higher rates feed through for another 9 months. You let the rest of the economy do that. You see spreads start to widen on corporate credit here because of earnings, and then overseas. That's where you're going to have the pain come in. And I think you're looking middle of next year for that.
Victoria, great to catch up. Thanks for being with us. Victoria Fernandez here with us in New York. To Jim Bianco, thank you to you as well, sir. After the jobs report from about an hour and 10 minutes ago, looking ahead to the long weekend. Enjoy the long weekend. Coming up, the payrolls report, giving the Fed just enough fuel.
It was a good number. I mean, it gives the markets a chance to take a little bit of a sigh of relief.
We'll get the reaction from the White House with the Labour Secretary, Marty Walsh, in just a moment after the president said more great news on Twitter just just moments ago. From New York, this is Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
Yes, it's about renewables.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Friday.
Why has Elon Musk said no to the car factory?
It's still in discussion. Let's see later the final result.
Do you think that by bringing people together, that is a way to solve conflict?
There must be communication, even if it doesn't necessarily resolve the problem. It is better to have dialogue than to have open conflict.
This is a conversation with President Jokowi of Indonesia.
Only on Bloomberg.
Live from New York City, I'm Jonathan Ferro for our audience worldwide. This is the open with equities looking like this. We're positive 0.4% on the S&P 500, on the Nasdaq 100 up a little more than 0.1%, close to 0.2% higher. From New York City for our audience worldwide on TV and radio, I'm Jonathan Ferro. We're joined now by US Labour Secretary Marty Walsh. Secretary Walsh, great to catch up with you, sir. Does this make your job a little bit easier going into the long weekend?
It certainly does. Going to Labor Day weekend, having 315,000 jobs add the economy and the labor participation force number going up as well. So that's a good way to enter the Labor Day weekend.
Been planning to ask you this question since I went to Jackson Hole and caught up with Fed officials last week. I'd love your reaction to this. Do you think higher unemployment is a price worth paying to get inflation lower?
Say that again. Sorry, say it one more time.
Do you think higher unemployment is a price worth paying to get inflation lower?
No, I don't think so, and I don't think that will be the case here. I think that, and again, I don't want to contradict what the folks in the Fed are saying, but when you look at the job openings in America right now, I think we're going to be consistently strong as we move forward here. I think we're going to continue to people be going back to work, having the unemployment, having the labor participation rate getting bigger. I think that's important. I think what's going to reduce the inflation is obviously the Inflation Reduction Act will help us on that. The gas prices continue to come down will help us on that. And then, you know, I think the biggest unknown is going to be what's happening with Russia and Ukraine.
This is what Chairman Powell said last week. He said higher interest rates, slower growth, and a softer labour market condition will bring down inflation. They will also bring some pain to households and businesses. He said this: a failure to restore price stability would mean far greater pain. You saying you disagree with that, Secretary Walsh?
No, you know, I think the chairman certainly has a lot more knowledge on this than I do. But my concern is what I don't want to see is people being laid off. I want to see continuously people go back to work, people being able to earn good wages. I think that, you know, overall, and again, we're at a very interesting time when it comes to our economy. Nothing that's been predicted or no indicators that we've talked about in the last 2 years is like any other time in the history of our country. So I think that, you know, as we think about inflation coming down, there's lots of reasons for why inflation went up, and it's not the same old pressures of the past.
Well, this is what Senator Warren had to say to CNN over the weekend in response to some of this. She said, you know what's worse than high prices and a strong economy? It's high prices and millions of people out of work. I'm very worried that the Fed is going to tip the economy into recession. Do you worry about the same thing?
No, I think the Fed's going to be very careful on what they're doing. I think they're taking a very consistent, unique approach to what's happening here. And I think that, you know, again, as we're already seeing some of the inflationary pressures not come down enough, but we're starting to see those numbers go down in the right direction. Clearly, we have a ways to go before we get to where we want to be in our economy when it comes to inflation and prices. But again, all of this was caused for different reasons. And I think that, you know, we just need to continue to work on supply chain. We need to continue to get goods and services into our country. And long term, we need to produce more here in the United States of America.
Just for Americans looking down to D.C. at the moment, Secretary Walsh, I think they're hearing the chairman of the Fed say one thing, and they're hearing another thing from the White House. The chairman of the Fed is preparing the American people for pain that we have to go through to get inflation lower. And I know other people out there think we can get a soft landing, but I'm not hearing that same concern about the future from you, sir. Secretary Walsh, why are you a little bit more optimistic than, say, this Federal Reserve?
Because we have a strong economy, and the president has laid down some really good foundation here for the future of what we're doing here in America. The infrastructure bill. I mean, I take a different approach to this as a former mayor of the city. I think about how do I grow my city. It's by investing in infrastructure. It's about creating more housing. The housing obviously is a little slow right now in the United States being built, but I think there's different reasons for that. And companies are still looking for people. We have, you know, we had a meeting a couple weeks ago at the White House that we're looking for 700,000 people working in cybersecurity. We have an ability to hire more nurses. We need more teachers. We have lots of jobs in our country that we need for the future of our country to stay open. So I think that when we think about bringing down inflationary pressures, I think it's going to look very different than it has in the past.
I think a lot of people hope that you're right and some other people are wrong on that front. Secretary Walsh, thank you, sir. As always, we appreciate your time, especially ahead of a long weekend. Thank you very much. Going into the Labor Day weekend. Secretary Walsh there from the White House. Mike McKee back with us to break some of this down. Mike, obviously, anyone with the White House at the moment, the administration, has got to tread carefully here, but we're getting different messages, aren't we, from different branches of the government?
Well, I think the Fed is trying to get people to accept the idea that things won't be perfect all the time, that we could see a recession or we could see a lot of people out of work. But so far, the numbers coming up good, both for the Fed and for the administration, because while we had unemployment tick up, it was because more people are coming in to the labor force, and that's kind of the way you want to see it develop. It was also broad-based. You look at manufacturing up 22,000. There's now 12,852,000 people on manufacturing payrolls. That's the most since 2008. Construction was up, even though housing has been struggling. So that was a bit of a surprise. Services are always good. The only people who are losing jobs at any significant number in this report were mortgage brokers, because the housing industry. So overall, good news. And it's overall good news that the participation rate rose, because it just shows that people are thinking they can get jobs. And with all those jobs open, as Secretary Walsh said in the JOLTS survey, this is exactly the kind of scenario that Jay Powell said was possible.
Makes his job easier going into the long weekend seems to be the takeaway here, Mike. The takeaway for all the guests on the programme after that payrolls report just seems to be whatever they thought before the jobs print, they still think for the Federal Reserve for September. Is that your takeaway as well, Mike?
Yeah, I don't think this is dispositive in any way, because we do have the CPI report coming up. This doesn't prevent you from going 75. This is a good report. It still shows strength in the labor market. But if we see a lot of inflation, then it locks in the 75. If inflation drops significantly, then we could see 50. My guess, They go 75 because they want to get up to that neutral rate and a little bit above as soon as possible, and then kind of sit there and see what happens.
Mike, keep going back to this. Did you ever think we'd be looking ahead to a week with the ECB and a 75 basis point move from the European Central Bank?
No, that is a real shock. But everything coming out of this pandemic has been just crazy. There's no models, there's no past history that matches up. So it's going to be very interesting to see what the ECB does.
The ECB saying they're willing to tolerate a recession. The Federal Reserve is just steadfast on getting inflation down, even if it means higher unemployment. Mike McKee, thank you, sir, as always. I want to get you some sector price action as well off the back of this move in the equity market, which so far has been pretty decent, up about 0.6% on the S&P 500. The last time I looked, up about 0.7% right now. The NASDAQ up about 0.5%. Abby, what have you got?
Well, John, you're right. It is a pretty decent move off the back of this payrolls report. And right now we have all 11 S&P 500 sectors rallying. So this really tells you that it's a broad-based rally as well, a broad-based move up in a difficult stretch because, of course, on the week we are lower. Now, the top sector on the day, energy up 1.8%. This is oil rebounds. We also have the financials higher, which is really interesting given the fact that yields are lower, especially that short end. But because of that, you, of course, have the yield curve steepening, which means that they're less inverted. That could help out the banks, materials, tech. So strong participation here from all the different sectors trading higher. On the week, though, I just mentioned we're looking at a down week, a pretty big down week, too, down 1.7%, the third down week for the S&P 500 in a row, the longest losing streak before the bear market rally started. So relative to some of the bigger laggards, of course, chips, we were talking about that yesterday with NVIDIA and some of the other chip makers really struggling with Broadcom, one exception today, but overall weakness there. The energy index on the week lower. The one sector that is higher, food, which is kind of interesting given that's a hot inflation area, but that's how the chips fall on the week, John.
Abby, thank you. About 22 minutes into the session, that's the equity breakdown. At the front end of the yield curve, yields aggressively lower now by 10 basis points, through 350 in the last 24 hours. Right now, 340. We'll pick up the theme on the bond market on Bloomberg Real Yield at 1 p.m. Eastern Time. Here's the lineup for you. Robert Tipper-Pejim, SocGen, Sibaja Rajappa, MUFG's George Concalves joining us as well. We'll see you at 1 p.m. Eastern Time for that one. Coming up next on this program, we'll get you the trading diary live from New York. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
I still think the Fed's going 75 basis points this meeting. The reason why this number is so important is the conditions for employment are so significant. The economy's in good shape. And when you cut across the numbers, I was looking at it again this morning, it shows an economy that's moderating, but certainly not slowing that much.
Rick Reader of BlackRock just 50 minutes or so ago, off the back of the jobs report, equities firmer up 0.5%. Willis Stick on the NASDAQ up about 0.4%. The bigger move is in the bond market, the front end of the curve. Just that Fed angst cooling just a little bit for now. I stress for now. Yields back in 10 basis points on a 2-year. Back to sub 340 at 339.76 after going through 350 in the last 24 hours or so. That's the price action. Here's your trading diary. Durable goods and factory orders at the top of the hour. President Biden speaking at 11 a.m. Eastern time. Then looking ahead to next week. Markets closed on Monday for Labor Day. US PMIs on Tuesday. Finally, remarks from Fed Chair Jay Powell on Thursday. And an ECB rate decision. And a big ECB rate decision at that. From New York City, that does it for me. If I don't see you at 1 p.m. for Real Yield, enjoy the long weekend stateside. This was the countdown to the open. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our targets.
Spare capacity is becoming scarce. We are running on thin ice.
No one deliberately wants to go into battle, but we sleepwalk into conflict.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
When you've had your fill of IPOs, ETFs, and CPI...
Tune into the lineup for some NFL, NBA, and MLB. Did you retire too early? I mean, look at some of these payouts.
I absolutely retired too early.
For the inside scoop on sports betting, catch the lineup right here on Bloomberg.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145. and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions.